Ladies and gentlemen, please take your seats. We will be starting already. Thank you. Good morning. Today marks a momentous occasion where we celebrate our unwavering commitment to knowledge dissemination and recognize the importance of informed economic discourse. As we foster an environment where ideas can be exchanged freely, let us remember that today is about engaging in meaningful discussions, gaining valuable insights, and broadening our perspectives. Now please join me in welcoming Senior Assistant Governor Iluminada Sicat of the Bangko Sentral ng Pilipinas to deliver her opening remarks.
Good morning. First of all, allow me to acknowledge the presence of former Reserve Bank of India Governor Duvvuri, Subbarao, former Bank of Thailand Governor Veerathai, Santiprabhob, Bank Negara Malaysia Assistant Governor Prashali Ismail, and SEACEN Centre Executive Director Mangal Goswami, and delegates of the other SEACEN member central banks. The BSP with the SEACEN Centre welcomes you to this year's Capital Flow Conference and the launch of the SEACEN Centre's book on challenges and options in managing capital flows for small, open, and financially integrated economies. This conference, as in previous years, has provided a venue to monetary authorities in the region to exchange insights on the effective use of policy tools to help contain volatility and minimize risks to efficient capital allocation. On top of that, the launch of the SEACEN Capital Flows book could not come at a better time, providing deeper information on the evolving complexities in the structure of international financial systems and the associated vulnerabilities and risks ensuing from volatile capital flows, as well as the rationale for a more robust policy framework. We have seen the challenge of managing the ebb and flow of capital greatly increase in the past decades. Home country bias has declined, and institutions and individuals are more willing and able to hold assets outside their own respective countries, attributed mainly to financial globalization. This structural change has given businesses access to a wider pool of investments and the opportunity to diversify risks across borders. Globalization has likewise provided firms with a broader market in sourcing the needed capital to support business expansion at a lower cost. More recently, however, signs of a trend reversal have been observed as evidenced by the decline in global foreign direct investments, pointing towards a less connected world. Despite this, capital flow movements remain broadly driven by a multitude of external and domestic shocks. For one, elevated inflation arising from a combination of supply chain disruptions and pent-up demand prompted synchronous and aggressive monetary policy tightening among advanced economies, as what we have seen in the second half of 2022. These likewise exerted downward pressures on currencies of most emerging economies, urging risk-off sentiment among investors. Meanwhile, the recent turmoil in the US and European banking sector dampened market confidence on the stability of the global financial system, entailing trade-offs which have clouded prospective monetary policy adjustments by central banks in efforts to arrest elevated inflation. Moreover, the International Monetary Fund, in its April 2023 Global Financial Stability Report, has cautioned on rising fragmentation, with geopolitical tensions further contributing to the already heightened uncertainty in the global economic and financial landscape. Risk of deglobalization and fragmentation have been on the rise and are likely to continue affecting regional economies through economic and financial channels, including trade and capital flows. These possible long-term structural shifts could slow down investments, impede technology and knowledge spillover, curb innovation, and reduce productivity, leading to broader economic costs, particularly on employment and output. The IMF noted the implications on macro-financial stability based on a long-term and severe fragmentation scenario. The study suggests that losses from trade fragmentation due to lower productivity may result in permanent global output losses, estimated at 1.5% of GDP. But these losses could be even higher in countries in Asia and the Pacific, by over 3% due to the prominent role of trade in the region's output. Nonetheless, amid potential stagnation in financial globalization, coupled with the emergence of geo-economic fragmentation, we are optimistic that capital flows to the region will remain resilient. The region remains an economic bright spot, with latest estimates by the IMF showing that Asia and the Pacific region is projected to contribute around 2/3 of the total projected global growth in 2023. China's economic recovery, which is expected to regain momentum throughout the rest of the year, is likewise expected to be a major factor for capital flows to the region. The rapidly evolving landscape of capital flows highlight the case for a more robust and innovative framework of integrated policy. The current rudimentary use of policy measures, namely foreign exchange intervention, macroprudential measures, and capital flow management measures, which in most cases serve as complements to monetary policy, should be reassessed and adopted onto a broader framework, given existing financial frictions, and to achieve macroeconomic and financial stability. Taking several factors into careful consideration, such as the coverage of the issues addressed by these measures, as well as their respective limitations, the development of a more comprehensive but flexible set of tools would allow us to strike a balance between the trade-offs, find the optimal policy mix, and the synergies among these policy responses towards achieving central banks' mandate of price, financial, and external stability. Thus, from a regional standpoint, cooperation and cross-border policy coordination among source and recipient countries in the region remains crucial and must be strengthened to avoid contravening impact of country-specific policies. On this note, I look forward to today's meaningful exchange of ideas. Let us all take advantage of this opportunity to learn from policy responses of other economies in the region as we accelerate coordinated policy responses towards a safer regional and global financial system. Thank you.
Our first panel will be a policy discussion on monetary policy framework and managing capital flows. This will feature a panel of former and current policymakers. We are indeed fortunate to have them all here with us. May we call on stage SEACEN's Executive Director, Dr. Mangal Goswami, moderator for this session, and our distinguished panelists. May we request our speakers to proceed to the center of the stage for a quick photo op.
This is working. Great. Good morning, everyone, and thank you very much for coming to this SEACEN-BSP Capital Flows Conference and the book launch. I hope you have had some good coffee, because capital flows is not an easy topic to digest, so you will need some caffeine to continue to stay resilient during this time. I wanted to first thank Senior Assistant Governor Iluminada Sicat for your hospitality, for BSP hosting this event. It has been fantastic. Since yesterday has been really great, and your staff have really been at the center of this, so thank you very much. There was just one thing we wished we had last night, a duet with you and A.G. Fra on Hotel California by the famous Eagles, because you can check in but you can't check out on capital flows. But emerging market countries have really evolved much more than that, and now we talk about resilience of emerging market countries despite all the shocks that we have seen. So indeed, it's my great pleasure to introduce this esteemed panel here, which will talk about how during their tenure here as central bank policymakers, they have managed to weather the storms, and what is the mantra going ahead, and how our central banks can actually manage this kind of a risk. So here, without further ado, let me dive right into it. We have Governor Subbarao, who was the central bank governor during the 2008 to 13. One of the things that, of course, is a pure advantage for him from his standpoint is that he has seen both the central bank as well as being at the Ministry as Finance Secretary. So he has seen this. We talk about fiscal dominance in emerging market countries. So clearly he has seen from both sides of this. Also, we have Governor Veerathai. Governor Veerathai is the one who actually sort of prompted us and encouraged us to get into the SEACEN view on capital flows. So many thanks for his enthusiasm. He needs no introduction in the region. He was at the helm at the central bank, at the Bank of Thailand for 2015 to 2020. And his accomplishments, of course, I will not take any more airtime, because it's all there written in the book. And also we have Dennis Bautista, who is the Director of Economics and Financial Forecast Group of the Economic Research Department of BSP. Dennis also has immense amount of experience, and he has just returned from the IMF in the ED's office there. So Dennis also brings a great deal of, all the magnificent things he has done with his department on capital flows, relating to capital flows. So let's start right away with Governor Subbarao. would you like to, you just sit and it's up to you.
Opening remarks, I'll go and talk from there.
Absolutely, if you prefer to.
Good morning. First of all, I want to congratulate SEACEN for this publication on capital flow management in small open economies. It's heavily researched, very insightful, very policy oriented. So congratulations and compliments to Mangal, Ole and your team for this publication. By way of opening comments at this panel discussion, I want to highlight 5 lessons that emerging economies learned in terms of capital flow management. 5 lessons of capital flow management. The first lesson is this. The old orthodoxy about capital flows was that capital flows are good always and everywhere. That full capital account convertibility and liberalization is the holy grail for all emerging economies. The faith in that old orthodoxy is broken. In fact, the old orthodoxy has rich intellectual credentials. When the Bretton Woods Agreement was being negotiated about 80 years ago, Henry Dexter White and John Maynard Keynes disagreed on virtually everything, except one, which is that capital flows are good for every country. Because it has a neat theory behind it, is that emerging economies, developing countries are short of capital. They need foreign savings to augment their domestic savings. Higher investment will aid their growth and prosperity. On the other hand, investors in rich countries have surplus capital. They don't get enough return there. So if they invest in emerging economies, they get a higher return. So it's a win-win formula. Higher returns for investors in advanced economies, higher growth and prosperity for emerging economies. But it never worked like that in practice. In practice, capital flows were large and volatile, lumpy. They impaired financial stability, they eroded competitiveness, created asset bubbles in emerging economies. In fact, virtually every financial crisis over the last 30 years, the tequila crisis in Latin America, individual country crisis in Russia, Turkey, or East Asian crisis in this part of the world, all were at heart a consequence of irrational capital account liberalization. That is the first lesson we learned. The second lesson, which is a corollary of that, is that the old orthodoxy has given way to a new orthodoxy. The new orthodoxy acknowledges that it is necessary, even desirable, for emerging economies at times to manage capital flows. But why did the old orthodoxy fail? The old orthodoxy failed because it was based on, in a world where trade globalization drove capital flows. Countries had trade deficits, so capital flew in to bridge the deficit. It did not reckon with forces of financial globalization that Lou referred to just now. The ferocious search for yield, which sends trillions of dollars across country borders every day. So earlier, it was current account which decided capital flows. Today, it is capital flows which decide the current account deficit. What is a remarkable intellectual shift? On account of the global financial crisis, the IMF came out with a revised institutional view on capital flow management. It was much bigger improvement on the old orthodoxy, but it came with many caveats, which irritated emerging economies. I can't go into all of them because I don't have the time, but just to give you one example, the IMF revised view says that emerging economies must or can institute capital controls only after they have exhausted all other measures. That's just not possible. I know from my own experience fighting taper tantrums in 2013, We had to institute capital controls right at the beginning. We couldn't have waited till everything was finished because the exchange rate would have collapsed. I can go on and on, but the point is that as much as the IMF has a revised view, it doesn't get far enough. So I spoke about the old orthodoxy, the new orthodoxy. Here's my third lesson we learned, which is that markets are very unforgiving of policy excesses by emerging economies. Let me illustrate that. In this part of the world, Asia, we had a devastating crisis in the late 90s. That crisis we know was caused by pegged exchange rates, high current and fiscal deficits, unfettered borrowing by financial and non-financial firms, loose regulation, erosion of prudential norms, and crony capitalism in parts of the countries. So there was a devastating crisis. Risk built up and there was an implosion. But here's the thing. Paul Krugman writes in his book Depression Economics that at around the same time, at exactly the same time actually, Australia had the same risk built up. Markets allowed Australia, a rich country, to make a smooth adjustment. Markets did not allow emerging economies of Asia to make a smooth adjustment. So the lesson we learn is that markets are very unforgiving of emerging economy excesses. The fourth lesson I want to talk about, which is in fact the subject of this panel discussion, is that there are many instruments for capital flow management. None of them is totally benign. None of them is totally effective. And all of them can be circumvented or gamed. For example, take capital controls. Capital controls we know can be circumvented. They're leaky. It's difficult to decide whether to stop inflows before they come in or after they come in. Do you have price-based controls or quantity-based controls? In India, for example, we have both. So it's very difficult to decide, and they're leaky. Take market intervention, the forex markets with your forex reserves. Our forex reserves are limited, and the markets know that. So every time a central bank intervenes in the market, it is a game between the markets and the central bank. And if the central bank cannot credibly defend the exchange rate, it can be a collapse of the exchange rate. What we've learned is that no defense of the exchange rate is better than a failed defense. Markets can game you, so emerging economies have to learn how to intervene in the forex markets. Then there's macroprudential policy. Macroprudential policy has become the big mantra after the global financial crisis. But macroprudential policies don't always help. In fact, one of the things that this book SEACEN has brought out, one of the things it points out, Ole, is that most flows today are through non-banking channels. And if flows are through non-banking channels, macroprudential policies cannot be very effective. Macroprudential policies are effective if flows are intermediated through the banking system. If flows are increasingly coming outside the banking system, macroprudential is not a solution. Then people talk about monetary policy as an instrument for capital flow management. Very difficult to use monetary policy, although we have used it in the RBI when I was governor, but very difficult. Because monetary policy is a blunt instrument. You don't want to use that lightly for capital flow management. Because we have this impossible trinity, which says that no country can at the same time have an open capital account, a fixed exchange rate, and independent monetary policy. You've got to compromise on one of them. So if you want to have capital flows coming in, you've got to compromise on some monetary policy independence. Take today's situation, for example. Many emerging economies want to reduce their interest rates because they want to stimulate their economies. But they're unable to do so because the Federal Reserve is increasing interest rates. So our monetary policy is hostage to international policy. Therefore, using monetary policy for capital flow management, although it is counted as one of the instruments, is a difficult instrument to use. One policy tool that Mangal, your report did not, I think, talk about is communication. Communication can be an important tool for capital flow management if it can be used wisely, intelligently. I've learned it the hard way, but I've learned it nevertheless, I hope, which is that communication credibly, timely, can help capital flow management. And finally, the fifth lesson emerging economists learned is that they cannot depend on the generosity of strangers. They have to build their own safety nets. We live in a financially interconnected world. What happens in one country affects other countries. In particular, what happens in the US, in Europe, in China, in Japan, impacts countries around the world, impacts emerging economies. We've urged, as emerging economies, we've urged advanced economies that they must be sympathetic to the spillover impact of their policies. But they've not been sympathetic. They've defended themselves by saying that they cannot subordinate their domestic policy to an international mandate. So this, what came to be called derisively as currency wars, became a dialogue of the death between emerging economies and advanced economies. There is no resolution. There's not expected to be any resolution because it's a difficult thing to resolve sitting in a conference room. So the net result of that, the net lesson we learned, is that emerging economies have to build their own safety nets. People talk about bilateral swaps, regional arrangements, the IMF. They're all safety nets, but I don't believe that any of them can be an adequate substitute for your own safety net, which is building your own reserves, building a strong economy, building a strong banking and financial system. So I've talked about 5 lessons that emerging economies have learned. In fact, I can talk about 50, but I don't have the time. So 5 lessons. The old orthodoxy is gone. The new orthodoxy has come, but that's not good enough. Third, policy excesses by emerging economies are punished by markets. Fourth, there are many instruments for capital flow management. None of them is totally effective or benign. And finally, that emerging economies have to build their own safeguards. Thank you very much.
Thank you, Governor Subbarao. Thank you. That was an excellent presentation. What rings out is you cannot depend on the generosity of strangers, so you have to build your buffers when times are good, and we can talk more about it during our session later. So let me invite Governor Veerathai to the stage, or would you prefer? That would be great. There's a presentation that.
Thank you very much, Executive Director Mangal. First of all, I would like to thank Senior Assistant Governor Iluminada Sicat and BSP for hosting this event and for the invitation, and also thanks very much to SEACEN. And also congratulations on the launch of your new book, which I find it very, and it's an excellent research, and it tells the stories of challenges that ASEAN central banks and SEACEN central banks have to go through. So congratulations. I totally agree with all the 5 points that Governor Subbarao had made in his opening remarks. In my presentation, I hope I'll try to explain a bit with some of the information based on my experience at the Bank of Thailand between 2015 and 2020. This is a brief outline of my presentation to give you the context of what the Bank of Thailand had to go through during 2015 up to pre-COVID, which was about as we all know, 2018, 2019. I'll draw lessons on the challenges and the policy responses that we learned through managing capital. Sorry, I had difficulty with my progressive lens with the slides. Maybe I'll watch this one. Okay, so this is a context of the operating environment that we were in. If you may recall, we had a coup d'etat in 2014, so the economy leading to 2015 was a very fragile one. The economic growth was less than 1%. And throughout the first 3-4 years of my term as the governor of the Bank of Thailand, we had fragile domestic recovery. And the recovery was also a very unbalanced one. As a result of the slow economic growth, we had very low investment, and that also led to large current account surplus. Current account surplus average more than 8% of GDP during 2015 to 2019. We also benefited from low oil prices and also surge in tourism, and all these factors leading to current account surplus. One point that I would like to make is that the current account surplus was also driven by the structural issues of the Thai economy. Not only low investment, but also we were entering aging society. As a result of the large current account surplus, we had strong external positions. If you look at the size of our international reserves, it increased from about 150 billion at end 2015 to 200 billion in a period of 2.5 to 3 years. And then another 50 billion US dollars was added by the end of 2020. We had relatively low short-term external debt. The amount of international reserves was about 3 times of the short-term external debt. So the Bank of Thailand could retain some degrees of monetary autonomy when we conducted our monetary policy. As a result, large current account surplus and capital flows that we had to deal with, the Thai baht appreciated quite substantially from about 36 baht when it took over in the September of 2015 to about 30 baht to US dollar at the end of 2019. The issues that we had when conducting monetary policy was that inflation had been below the lower bound of our target range, and this was a policy issue to which extent we would need to be aggressive with our monetary policy stance to bring inflation back within the target range. The other challenge that we had to face was related to financial stability. There were many signs of financial stability risks emerging in the country. Very high household debt. Thailand, unfortunately, if you look at all countries with the same level of GDP per capita, Thailand is among the countries that have the highest household debt. Shadow banking activities were also expanding, particularly through the saving cooperatives, lending a lot of money to households and also to small enterprises. We also had surge in unrated corporate bonds, and this has a form of shadow banking activities for the large companies. The mortgage loan portfolios were also, the quality was declining. The sign of housing bubble. People were basically buying houses, getting mortgage, and getting cash rebates from incurring mortgage, and that was an issue that we had to face, and that resulted in rapid expansions of real estate supply. The macro-prudential measures were I would say, in the preliminary stage back in 2015, 2016. So we had to launch a range of macro-prudential measures from credit cards, to deal with credit cards, personal loans, unrated bonds. We had to introduce loan-to-value ratios to calm the real estate markets, and also had to revamp regulatory frameworks of saving cooperatives. So those were the context of the operating environments that the Bank of Thailand had to face with back in 2015. And then we had to deal with these capital flows. What we observed was that the capital flows, particularly the portfolio flows, I mean the foreign direct investments, we didn't have to worry so much, but the portfolio flows were the one that created a lot of challenges for SOFIs. By the way, I like a lot the word SOFIs that you use in the book, small, open, financially integrated economies. I think it's a very good terminology. What we found was that capital flows during that time were influenced mainly by changes in global financial conditions, not by interest rate differentials. I mean, the orthodox view would be that interest rate differentials would lead to capital flows. But if you look at the chart on the left-hand side, this is the capital flows to Asia and global financial conditions. You basically see a positive correlation. These are the green dots. If you look at the red dots, those are the relationship between capital flows to Asia and interest rate differentials. You don't see as robust a correlation. And as we had to deal with whenever there was a news about policies by the Federal Reserves, and that triggered capital flows to emerging markets. Capital flows also led to asset price surge, underpricing of risks, and credit growth that could amplify financial stability risks. And we could see this through various channels. Underpricing of risks was quite rampant. We had foreign banks, branches of foreign banks, offering very low interest rate short-term loans to corporations in Thailand. And everyone thought that this would be short-term loans, but many of those short-term loans were used to finance long-term projects. So that's a sign of underpricing of risks as a result of capital flows. Everyone was competing for new business, not fully appreciating the risks that these projects would involve. The chart on the right-hand side clearly shows the relationship between capital flows to Asia and financial conditions in Asia. Basically, it increased the liquidity and it contributed to expansionary financial conditions in Asia. The other, if I may add to Governor Subbarao's presentations, there was an orthodox belief that an exchange rate would be a stabilizer of external shocks. But because of capital flows and these rapid and volatile capital flows, from our experience, instead of being stabilizer of external shocks, exchange rate was indeed an amplifier of external shock, amplifier of capital flows. At that time, because of our strong external positions, the Thai baht was deemed as a regional safe haven currency. And when there was an exchange rate appreciation, or belief that the exchange rate would appreciate further, and that led to capital inflows, which in turn would put appreciative pressure on the exchange rate. And this is a simple chart that we did, looking at the relationships between the monthly change in the ADXY, the Asian, the value of the Asian currencies on the x-axis, and the flows to emerging markets Asia on the next month. So you could see some positive relationships between the degree of exchange rate appreciation and capital flows to Asian countries in the following month. The chart on the right-hand side, we look at the three episodes of rapid currency appreciation in Thailand, looking at the relationships between capital flows and Thai baht movements, and we could see the positive relationship. That's whenever there is baht appreciation, that also resulted in inducing more capital inflows, particularly through the bond markets. So exchange rate appreciation invited more inflows, which led to more pressure on the exchange rate. And exchange rate has been an amplifier of external shocks. So given the context and given some of the challenges, what were the key lessons learned? The first lessons, I think recipient countries of capital flows had to bear the full burden of adjustments to the volatile capital flows. We can't depend on the generosity of the strangers, as Governor Subbarao mentioned in his opening remarks. The source countries had paid little attention to the unintended consequences of spillovers from their unconventional monetary policies. And indeed, when we talk about bearing the full burden, central banks of emerging markets, their hands were also restricted by a number of arrangements and views, policies of the different international financial institutions and also advanced countries' assessments. We all had to deal with the like of currency valuation analysis. When we wanted to introduce measures against non-residents, some of the international financial institutions would think that would go against the institutional views on capital flows, despite the fact that non-residents were basically the source of these capital inflows. It's not a discriminatory measures, but it's basically we try to address the source of the problem, the root cause of the problem. Countries like Thailand, that we had liberalized our capital account early on, and if we wanted to introduce something, it would be considered as a reversal of capital account liberalization. Okay, and that's not well received by the IFI's community. With the US Treasuries, we also had to deal with the risk of being branded as a currency manipulator. That could have significant consequences on trade balance and also on investment balance. Okay, so these are all the restrictions. Apart from we had to bear the full burden of adjustments, our hands were also restricted by these measures. So we have to be prepared to take care of ourselves for capital flow reversals, building buffers, making sure that our financial system was strong, our economic structure was strong, and that would require some kind of preemptive measures as well against too much inflows. So that's the first lessons I would like to highlight. The second lesson, in the case of the Bank of Thailand, we adopt what we call the leaning against the wind policies. And despite the fact that inflation was below the lower bound of our target range, we decided not to lower our interest rate policy further. We didn't believe that by further lowering the interest rates, it would transmit into higher inflation, and it would stop capital inflows, because capital inflows, as I mentioned earlier, were driven mainly by global financial conditions, not interest rate differentials. But we believe that to reduce financial stability risks, combinations of leaning against the wind policies, is making sure that the interest rate is at the right level, and introducing macroprudential measures, and that would be the right combinations. Macroprudential measures and monetary policy stance needed to be complementary. There were views that you have to look at one policies for one objective, but indeed to address financial stability concerns, the combinations of policies was proven to be important, particularly making sure that we have the right monetary policy stance and macroprudential measures. So that's the second lesson I would like to highlight. The third lesson is related to the point I made about exchange rate could become an amplifier of risks. So foreign exchange intervention was needed indeed to handle or to deal with short-term capital flows and minimize unintended consequences on the real sector, particularly the SMEs who didn't have good access to hedging mechanisms. So we conducted two-sided foreign exchange interventions to limit the amplifying impacts of changes in the exchange rate on capital flows. And foreign exchange interventions also help us build international reserves. And this is the buffer that emerging markets would need to build for themselves in preparation for capital flow reversals. The fourth lesson is related to capital flow management measures. We did not introduce any drastic measures against non-residents. We adopted what I would say is measures to throw sand in the wheels, creating some frictions for non-residents, discouraging them from placing hot money, short-term hot money in Thailand or in Thai financial instruments. So we had to reduce the supply of short-term Bank of Thailand bonds when we found out that basically non-residents use short-term Bank of Thailand bonds as a way to place short-term deposits in Thai baht. And we created some frictions on the Thai baht liquidity management mechanisms used by non-residents. We also introduced the disclosure requirements of end beneficiary investors, so created a bit more cost for them. So they had to disclose who were the end beneficiary of bond holders. That all the banks, particularly the foreign banks, would have to incur some steps in helping their customers disclosing this information. And as Governor Subbarao mentioned, the communication was very important. So we had to communicate that we didn't like short-term capital inflows. We were concerned about the exchange rate. And all this open communication introduced some forms of uncertainty risk premiums against short-term inflows in the views of foreign investors. The fifth lesson, why we had to deal with all these policies and policy tools, we also need to make sure that we developed the breadth and the depth of our foreign exchange market to make sure that private sectors, particularly the SMEs, had ways and had tools to deal with exchange rate movements. We used to believe that SMEs could go to banks and basically buy or sell forward their foreign exchange. But it's not that easy. Many of them had credit line limitations. Many of them didn't know how to manage foreign exchange rate risks. So we try to introduce one measure is some kind of option mechanisms for SMEs working with the Exim Bank, and that would be easier for them to digest. But obviously the cost was high, so we had to find ways to subsidize them. We had to create big programs to educate SMEs on foreign exchange management, to give them with some forms of financial literacy about FX hedging tools. We also had to liberalize outflows to create balance between inflows and outflows. So we introduced capital account liberalizations for Thai investors. We allow qualified investors to invest abroad in a much broader arrangement. Before, Thai investor wishing to invest abroad, they would have to go through Thai intermediaries, the like of securities company in Thailand or asset management companies in Thailand. We liberalized that so they could go abroad directly by themselves. We also raised limits on collective investment schemes, taking money from Thai investors investing abroad, the like of foreign investment funds, mutual funds. And we also launched the qualified company schemes for companies doing foreign exchange transactions. We had limited foreign exchange supervision. So it was also a good opportunity for the Bank of Thailand to review all the foreign exchange regulations with a view to promoting outflows and creating better balance between inflows and outflows. And the last lesson is the limited policy space. Obviously, as a central bank, when we talk about limited policy space, we tend to focus on how much lower the policy interest rates can be. But that's not only limited policy space that central bank could face. policy space was needed to be evaluated across different aspects and different policy objectives. Because of financial stability concerns, the lower bound of interest rates in emerging markets, in my view, would not be zero. If we lower our policy interest rate to zero, it could create a lot of financial stability risks in an economy. We also have to deal with credibility of the central bank by being careful about the effect on the central bank's balance sheet. That's another limited policy space that basically constrained our operations. When we did sterilize foreign exchange intervention, we had to, we accumulated a lot of reserves, and when the baht continued to appreciate, and that created unrealized losses on the central bank's balance sheet. And when we conducted sterilized operations to sterilize the amount of liquidity as a result of FX intervention, and the earnings that we got from investment of our international reserve was lower than the domestic policy rate, negative carry, and that's also resulted in another financial losses for the central bank's balance sheet. A lot of communication need to be conducted to ensure credibility of the central banks. The Bank of Thailand, during my time, we had negative capital for a few years as a result of losses of all these operations. And also, the other limited policy space was the currency, the possibility that one could be branded as a currency manipulator. These are limitations on the amount of foreign exchange intervention that a central bank could do. Okay. Let me end by quoting Governor Rajan of the Reserve Bank of India. I very much like this quote. Monetary policy is like juggling 6 balls. It's not interest rate up, interest rate down. There is the exchange rate. There are long-term views, there are short-term views, there is credit growth. So policy framework and tools need to be integrated and sufficiently flexible to allow emerging markets, SOFIs, to navigate volatile capital flows and address financial stability concerns. Thank you very much.
Thank you, Governor Veerathai. Thank you very much for your insightful presentation. In fact, you sort of squared the circle which Governor Subbarao mentioned about communication, which is partly missing in this book, especially when you have such losses crystallize because of your FX intervention and the sterilization thereof. And how do you communicate that the central bank's balance sheet is indeed under stress from losses? So communication is clearly an important part that we should further incorporate in our studies. So without further ado, let me ask Dennis to take the floor.
Good morning. Welcome to Manila, and congratulations on the book launching. Thank you for our SEACEN colleagues for co-sponsoring this panel conference with the BSP. It is a great pleasure to join everyone today to discuss our country experience and insights on monetary policy framework and managing capital flows and the need for broader policy tools and options. This is a topic which is crucially important from a macroeconomic and financial stability perspective. The unique confluence of post-pandemic recovery and Russia's incursion of Ukraine highlighted how supply shocks, which are often initially viewed as temporary, can have broad-based and persistent inflationary effects with unprecedented speed. As such, central banks mounted a more aggressive policy stance to respond to these shocks. While the monetary authorities' front-loading of policy interest rate hike was certainly necessary, such policy actions could also lead to a sharp tightening of global financial conditions and in turn trigger capital flow reversals, especially for economies with pre-existing fiscal and financial vulnerabilities. So let me walk you through an overview of the trends and developments in capital flows in select SEACEN economies, and maybe in this case, what we call Southeast right now. Then we'll touch on the set of policy tools and options that can be deployed to address the risks associated with capital flow volatility. And to provide a country perspective, I will share the Philippine policy responses to managing capital flows. And towards the end, my message will emphasize on the importance of having an appropriate mix of policy responses that complement each other, since there is no one-size-fits-all approach in responding to disruptive capital flows, which highlights for responses to be tailored to country specificities. Analyzing the trends and developments in cross-border capital flows across different episodes of crisis periods is essential for informing and designing context-specific policy decisions. In the run-up to the global financial crisis, the emerging economies largely benefited from a confluence of factors such as low interest rate in the United States, rising commodity prices that favored commodity exporting emerging economies, and substantial capital inflows. However, a decade, and I refer to 2000 to 2010, of robust economic growth in emerging economies, the risks have shifted from advanced economies to emerging markets following the US Fed's taper tantrum. The same trend was also observed during the height of the pandemic and the Russia-Ukraine war, when select SEACEN member economies experienced sharp outflows of foreign portfolio investments in equity and debt securities. Consequently, the potential repricing of risks of financial assets and capital retrenchment from emerging markets could lead to depreciation pressures on their exchange rates. There are 5 potential tools that policymakers can deploy to manage and address the risks associated with capital flow volatilities. And these are foreign exchange intervention, monetary policy, fiscal policy, macroprudential policy measures or MPMs, and capital controls. These tools are deployed to address specific risks related to capital flow volatility. Central banks employ FX intervention to contain the volatility of the exchange rate, reduce perceived exchange rate misalignment, and accumulate foreign exchange reserves. Meanwhile, monetary and fiscal policy respond to inflation and economic overheating concerns caused by capital inflow windfalls. Macroeconomic measures are deployed to address excessive credit growth and financial stability risks, while capital controls, which limit the volume of capital inflows and outflows, can be applied to respond to balance sheet weaknesses, overheating concerns, and currency appreciation pressures. Let me now turn to the Philippine experience. In responding to capital flow volatility, the BSP relies on an expanded policy toolkit. First, maintaining a market-determined exchange rate has always been the BSP's first line of defense to responding to external imbalances. This means that the BSP only deploys FX intervention policy to the extent that exchange rate volatility threatens the inflation target or exerts sharp fluctuations in the market. This policy approach afforded the BSP to accumulate ample international reserves, which serves as the country's liquidity buffer against external shocks, especially during the periods of strong capital outflows amid currency depreciation pressures. In the Philippines, structural inflows from foreign direct investments are relatively or fairly stable on the average amid the existing investment incentive and regulatory system. Second, The BSP can choose to respond counter-cyclically to capital flow volatilities if monetary policy space is not constrained and domestic conditions permit. But we mostly turn to macroprudential measures to target the specific imbalances and prevent the buildup of risk in the financial system. For instance, during the height of the pandemic, some of the BSP's macroprudential measures were relaxed to complement its monetary easing responses. Meanwhile, the BSP remains cognizant of the potential effects of implementing capital flow management measures, or CFMs. While resorting to capital control remains an option, especially if fiscal policy is constrained amid current heightened capital flow volatility, these measures may prove difficult to enforce given the long-term economic costs they might entail, such as their potential to deter foreign investment and slow financial market development. To conclude, let me emphasize that countries are faced with varying circumstances, and no single policy tool can address all needs. Again, pointing out on policies that are tailored to country specificities. We believe that implementation of a mix or suite of policies that complement each other is the systematic way to address specific policy objectives. For instance, in the recent empirical study conducted by the IMF, they conclude that policymakers in emerging market economies respond to capital flows by deploying a combination of instruments such as FX intervention, monetary and macroprudential policy measures. The harder part, however, is determining the optimality in the policy mix. What is clear is that structural reforms and sound macroeconomic policies are indispensable components of integrated policy framework. Likewise, while a flexible exchange rate management may lessen the severity of the impact of sharp capital flow imbalances amid its automatic stabilizing effect, it is also critical to support this strategy with ample financial, fiscal, and external buffers. With this, let me end my message, and again, thank you, and we look forward to engaging with our SEACEN colleagues on these important issues. Thank you.
Thank you, Dennis. Thank you very much. I think the clock is ticking faster than my heartbeat, so we need to race. And I know Governor Veerathai has to leave for the airport sharp at 10 o'clock. So we will quickly get to the... I will raise a broad question to begin with, and then I think there may be many who would like to ask questions, so I will open the floor up to that. My first broad question to all the panelists is that the world is changing rapidly. Its complexity is becoming much more onerous for policymakers. It's becoming much more difficult given that shocks come repeatedly from different sides that are unexpected. And how, in a world like this, from your point of view, does policy flexibility in your monetary framework help as opposed to having a more dogmatic or orthodox rule book? How would you sort of script the role of flexibility, policy flexibility, as opposed to being much more dogmatic, going by the rule book? And as a practitioner, I mean, Governor Subbarao, maybe you can give us a bit of a flavor of, some examples of when you faced that, especially maybe in the context of, during the earlier part of when India was part of this whole fragile five. I remember when you had large current account deficits that was being financed by capital flows. What kind of flexibility, or even going forward now, what kind of flexibility do you think it needs?
Thank you for that question, Mangal. I think flexibility is easier to talk about in a conference room like this than in actual policy setting, because it's not very easy to shift from one regime to another. markets get unnerved, and public policy can get into a disarray if you shift abruptly. For example, during the taper tantrums that you spoke about, Mangal, when India was one among the fragile five, along with Turkey, Indonesia, Brazil, and South Africa. We were one of the fragile five when the rupee depreciated by about 20% peak to trough in about 4 months. The RBI's stated policy, Reserve Bank's stated policy, was that we will intervene in the market only if there is volatility in the exchange rate. What is volatility is never defined. So every time you intervene, by inference, you deduct that there was volatility. Even if the exchange rate is moving one way, it is interpreted as volatility. Now, no statistical book or no statistics professor will tell you that a one-way movement is volatile. But central banks treat a one-way movement as volatile. I, for one, was very uncomfortable about the Reserve Bank of India not walking the talk. That we say that we will intervene only if there's volatility. And I don't see any volatility. I will not intervene. But my staff were very uncomfortable with that. They said no emerging economy just sits back and waits for the exchange rate to move as it likes. You have to intervene, because if you don't, you get into trouble, because markets are expecting you to intervene. Not so much because you need to intervene, but because markets are expecting to intervene. I wanted to affect a policy regime, actually, that you don't intervene every time there's an exchange rate movement, because if you do that, market participants are going to outsource their exchange rate management to the central bank. Because every time the exchange rate moves and the central bank goes into defense of the exchange rate, market participants will game you. They'll just speculate and they'll make money on you. So in order to prevent that, in order for India to grow up in the foreign exchange market, that people who take market risk should be able to manage the risk themselves without the central bank holding their hand, I wanted to introduce that regime. But our people resisted, perhaps for good measure, because the Reserve Bank of India has more institutional wisdom than I had as a governor, so I succumbed to their wisdom. But I think this is something that, you know, like you talked about flexibility. So should we introduce that flexibility? And they told me that this is not the time, a crisis time is not the time to introduce flexibility or effect a market regime change. You should do it in peaceful times. First, there is never a peaceful time. Second, when there's peace, you don't think about, oh, what should I do now? You're enjoying the peace, right? So it's only when you're in trouble that you're thinking about what regime change you must introduce. Then there's resistance, there's problem, there is you cannot do it, and then the problem gets over, you get over it, and you're back to normal. So the long answer to your short question is that regime changes are easy to talk about in conferences. In actual policy setting, they're much more difficult.
Thank you, Governor Subbarao. Indeed, as you mentioned, that emerging markets never have peacetime. So whatever window you have, you need to manage it very well to build your buffers and resilience. On that, Governor Veerathai, regarding flexibility, I mean, Bank of Thailand was a bit on the other side, where you had a surge in inflows and you were trying to manage the pressures on the exchange rate and the financial stability. And how do you use flexibility under those circumstances, or under circumstances currently in forging policy?
Yeah, there were two important words in your questions. One was flexibility. The other one was about rule book. You know, to be able to conduct flexible policies, the prerequisite is your credibility and the buffer. It was very important to have good credibility, strong credibility, to be able to, to communicate to the market that, this is the right thing to do, despite the fact that it might be some deviations from the rules. We needed to be able to explain to the market that why we had to deviate from some of the rules. As I showed in my presentation, although we had flexible inflation targeting and inflation was below the lower bound of target range, but we thought it would be the right thing to do by not further lowering the policy rate, and basically think of the policy as an integrated framework. So you need a strong credibility, and you also need to build good enough buffer to be able to deviate from the rules book, to have some forms of flexibility in policy making. The other important word in your question was related to the rule. Okay. What we found missing in the traditional inflation targeting framework, and this could be a topic for another research by SEACEN. We were trying to find ways to integrate the considerations on financial stability within the monetary policy framework, the inflation targeting framework. I think this is also a research that's being conducted in many parts of the world. I think there's no clear solution yet as to how best to incorporate financial stability into the policy rule books. But once there's an awareness among the groups of policymakers and also the stakeholders involved, they would not think of our action as pure flexibility, but it would be a part of the rule book, and this could be a big contribution to central banking going forward. And if I may go back to the point that Governor Subbarao made earlier, it's very difficult to convince advanced economies to analyze unintended consequences of their monetary policies to emerging markets. But when you look at what happened with Silicon Valley Bank, if they had incorporated financial stability into their consideration, their deliberations of monetary policies, could be that the QE would not be as aggressive as was conducted by the Federal Reserves. So by making sure that central banks know and have some ways of rules to incorporate financial stability into monetary policy framework, I think that would produce a very good contribution to the policy circle.
Thank you, Governor Veerathai. Let me just quickly ask Dennis as well. How has BSP sort of handled this kind of, maybe under the current circumstances, has policy flexibility sort of helped or hindered?
Hello. Yeah. Thank you, Mangal. I echo the sentiments of our speakers here, and earlier on, I emphasized the difficulty of having a policy mix. And having said that, I think that a solid understanding of the policy mix and the policy trade-offs that are confronting policymakers in this light had to be well taken cared of by a more systematic and analytical approach. This said, however, I would think that the central banks need to enhance the tools further to consider all this policy flexibility and also build capacities and conduct more research on how this policy mix can affect the economy going forward. And in terms of and speaking of flexibility, the BSP for its part is looking at on one of the tools that we're considering is a model building approach, that a gap model that could incorporate several sectors in the economy. Together with IMF, we're working on it, and we're trying to come up with the policy simulations that incorporates all these sectors of the economy together in one IPF-like policy recommendations. And we hope that by gradually testing this and towards its adoption, possibly we could also enhance the way we communicate, which is a big issue also in terms of managing macroeconomic stability.
Thank you, Dennis. Indeed, lessons from BSP has also been on the forefront of policy making that is well regarded in the market, and you have done a good job of actually managing the shocks. So I think this is good learning for us. I think there are many people out here who may want to ask the practitioners some questions. I will take this opportunity to open the floor if there are any questions at this point. I have many, but I would defer to the floor first if there are questions from the floor. You have a pretty shy group today. Yes, Senior AG Sicat.
I have two questions, one for Governor Subbarao and another to Governor Veerathai. For Governor Subbarao, you mentioned earlier that macro-prudential policies are not effective, especially now that capital flows are channeled to non-financial institutions. Would you say that capital control will be a good substitute policy? And for Governor Veerathai, my question is, you liberalized outflows during the episode when you had capital inflows. Was there a time that you reversed this policy, especially during the time when capital outflows, a capital outflow episode occurred recently? Thank you.
Thank you. Governor Subbarao.
Okay, thank you for that question, Senior Assistant Governor Liu. Your question was, because macroprudential policies, as I said, are ineffective in today's situation, because capital flows are routed through non-banking channels, would capital controls be an alternative? Yes and no. Yes, because capital controls are one of the policy instruments available for managing capital flows, but I don't believe they're the only instrument. In the alternative to macroprudential, there is foreign exchange intervention, there is monetary policy, there's communication that Veerathai and I both spoke about. So I believe what policies or what policy mix you use to manage a certain situation depends on that situation, that time. It's not, there cannot be a hard and fast rule. In fact, I don't believe anybody can write a textbook about this is what you have to do in this situation. Because real life always surprises our textbook scenarios. So I don't think it's possible to determine like that a priori. But having said that, I must also say that in the Reserve Bank we had, and I'm sure that all central banks have an SOP, a standard operating procedure, and have accumulated experience about what to do when. But it is never the case that we are using only one instrument at one point of time. It is several instruments all the time, including communication, to manage the crisis until it is over. Thank you.
Thank you.
The quick answer is that we haven't reversed our capital outflows liberalizations, and this related to the thinking that we had when we decided to liberalize capital outflows. Firstly, we had to conduct detailed analysis of the potential impacts of our capital outflows liberalizations. When we decided to do so, we had sufficient reserves, we had good understandings of the types of investors, the types of Thai investors that would be eligible and would be willing to take the money out of the countries and invest abroad. And during the episodes of market volatility, indeed, those who basically took the money outside Thailand suffer more losses than those that retain investment within the country because of the market volatility. And there was also a home bias by Thai investors Okay, if you're not super rich, it's much better, much easier to manage your finance in the domestic market. The other reasons why we decided to liberalize capital outflows was to provide ways for Thai investors to be able to diversify their risks instead of putting all investments within the Thai baskets. So we thought that by allowing them to be able to diversify their investment portfolios across the globe, that would be better. We didn't have we didn't have to experience any rapid outflows by Thai investors, so we didn't have to reverse that policy.
Yes, please.
Can I supplement my answer? As I just finished answering, I was thinking about my answer to Liu, which is that, in fact, I'm subject to correction on this, that when you're managing capital flows and an exchange rate crisis, you don't want to be predictable. You don't want a shared textbook everybody has, and this is the situation, this is what the central bank will do, because your policy will then become ineffective. So not being predictable, I think, is one of the important ingredients of capital flow management and exchange rate management. It's not that we will act erratically. We have a game plan, but that game plan is implemented unpredictably so that the market cannot game it. Thank you.
Did you have a comment?
Just wanted to add to Governor Subbarao's point. We were criticized a lot by not being transparent about our policy options, but that's by design. We basically communicated our dissatisfactions of short-term inflows, and that's part of creating some forms of frictions and uncertainty risk premium in the eyes of foreign investors, in the eyes of non-residents. Okay. So by expressing our directions, our policy intention, but not disclosing in details the potential menu list of policy actions on CFM.
Especially during a crisis period, because it's difficult to really fathom where you are going, which direction you are actually proceeding. So your point is very well taken. Thank you very much. Are there any other questions from the floor at this point from Nepal Rashtra Bank? Yes, please. There is a mic. If you could step to the... I can...
Thank you. I'd like to thank all panelists for nice and insightful presentations. Just I'd like to ask questions to all panelists. Anybody can answer. It's just for, I am from Nepal Rashtra Bank, Prakash Shrestha. What could be the suggestion for those countries which are yet to open capital account fully to move forward from your own experience? Thank you. It's a straightforward question. Thank you.
This is a very loaded question. Governor Veerathai, would you like to maybe give your...
Open capital account fully, personally, I don't think that would be a one decision. Decisions regarding capital account liberalizations, I think needs to be very well calculated and needs to be gradual. The reversals of capital account liberalization could create a lot of cost to the society as well, and could also damage credibility of the central bank. So I would not subscribe to the view that one should consider the decisions to open capital account fully. Thank you.
Governor.
Yeah, the straightforward and boring answer to your question is that you learn from the lessons of other countries, and there's enormous amount of experience. But as Veerathai said, I want to mention one thing, which is that capital account liberalization, as someone said, is like joining a mafia. It's a one-way street. You can liberalize, but regressing is a very, very costly move. So every forward step you take, you got to do it very deliberately, because taking a backward step is going to cost you enormously in terms of credibility. So even if you deliberate too much, that's okay. But make sure that you do not take a back step. It cannot be 2 steps forward, 1 step back. It's always got to be a progressive forward movement. Okay, it's like you can't get out of a mafia.
Dennis, would you like to? Okay. So I guess the general framework is long-term first, short-term later, risk sharing first, equity, risk-bearing debt later. So that's sort of the general dictum, I guess. But of course, it's much more difficult when you want to implement that. So with that, let me further questions from the floor. I think this is a yes. Bank Indonesia. I think Indonesia was one of those countries which liberalized quite quickly, and now often they wonder if that was the right sort of policy to take. But maybe he's got
Thank you, Mangal. I'm impressed with the way. Okay, thank you. I'm impressed with the way of Governor Subbarao explained the flexibility that when he was the governor at the time, and considering the policy mix that the three of you discussed about that. I'd like to ask about, is there any change in your policy settings in terms, including the flexibility, when regard to the nowadays growing or soaring GDP over loan over GDP growth since the COVID-19, right? And then that eventually will affect our foreign reserve, the challenge to the foreign reserves, and also the challenge to the increasing natural interest rate. Thank you for that.
I think he's talking about the credit growth in the economy being anemic.
Yeah, I think the way I understood it, is there any change in the Reserve Bank's policy? The short answer is I cannot speak for the Reserve Bank anymore. I don't know if there's been any change. But what I do know is that today's situation is quite different from the situation we faced when I was governor. Today, the Reserve Bank of India has robust foreign exchange reserves. The other thing I want to point out, as I was talking to my RBI colleagues earlier this morning, which is that it's a different ball game when you're one of a few countries in the world having a crisis, as distinct from the whole world having a crisis. If you're one of about 40 emerging economies having a crisis, it's a different situation. But if you're one of only 5, or if you're only one of 2, or the only country having a crisis, you have a much more difficult situation managing that. Take, for example, the financial crisis following COVID, right? It's not just a handful of emerging economies that were there. The whole world was there. And in terms of the hierarchy of concerns, financial crisis was way down, below COVID. The whole world was worried about COVID, and financial crisis arising out of COVID was a secondary concern. That is easier to manage than managing a crisis when you're one of fragile 5. So one answer to your question is I do not know if the Reserve Bank has had a change of stance because they don't declare this. Second, it's different when you have robust foreign exchange reserves as against when you have limited reserves. It's different when you're one among a few countries or when you're one among many, many countries having a crisis.
Thank you, Mangal Goswami. Did you want to?
Let me add quickly. It's definitely post-COVID-19. There is one major change in operating environment for central banks. It's the issue of debt overhang. The balance sheets of SMEs, balance sheets of households got affected, significantly because of COVID-19. I think that's an additional constraints, or it could also be considered as an additional objective of policies that central banks need to consider post-COVID.
We would love to be flexible here and ask you to stay for another hour for questions and answers, but we can't implement that because you have to have the flight. And so we have to end very soon. But I think it's great that we have, two ex-governors here, in our panel here. So what I would say in closing, I would ask for a very short 1 minute. If you can, there are a lot of heads of research here, doing a lot of good research work in the central banks. What is your mantra to them going forward? As a governor, you have seen it all. What do you tell them as a governor? Just it's a very, I'm sorry this came from the left field, but just your vision as to, or advice to the research, people here. How do you see them?
1 minute, I would just say read the book and help expand the wealth of knowledge in this book. I think it has done very good research, very clearly state the policies, constraints, policy objectives that central banks have to face. And these issues of volatile capital flows will continue to be with us, and we need to take care of ourselves. We can't expect source countries to understand or to care about unintended consequences of their policies. So read the book and help expand the knowledge, the wealth of knowledge in this book. Thank you.
Thank you.
Yeah, one advice I would give them is that remember that central banks operate in the real world. Central banks are not silos by themselves. What I've found among central banks is that it's a very incestuous community. That you don't realize that there's a world outside. I have this thought experiment actually. If you take a survey of inflation expectations of central bank staff, and if you take a survey of inflation expectations of the larger public, there'll be a vast difference. Because central bankers read about inflation, they don't experience inflation. It is the larger public that experiences inflation. In fact, when I was having a conference with my senior analysts in the RBI once, we were talking about inflation. We talked about it for 2 hours, numbers, this and that, analysis, etc. And I said, how many of you went to a market and bought vegetables? None. And neither did I. So the point is, as much as you researchers in central banks, remember that there's a world outside. The research that you do and the research that you do has to influence the outside world, and you've got to be taking into account what's happening in the outside world in doing your research.
Thank you. Dennis, do you agree with this?
Yes, I agree. Just one thing. I would encourage everyone to do research that is very useful for operational purpose also. Because the difficulty really is coming up with a reference for day-to-day operations of central banks.
Thank you, Dennis. I think the advantage is that, after you leave your office, you can talk more openly. So I think this is the advantage of having them here. So fantastic. Thank you so much, Governor Veerathai, Governor Subbarao, and Dennis for being here, taking your time to fly out here. We are very thankful for you and grateful to you for your time. Thank you very much. Safe travels, Governor Veerathai.
As we take a break, may we invite you to the foyer outside to partake in some light refreshments. We will resume the next session in 30 minutes. Please come back by 10:30 a.m. Thank you.
Wala na? Wala.
Ladies and gentlemen, we will be starting. Please take your seats. May we welcome back to the stage Dr. Mangal Goswami to bring our attention to the highlight of today's conference, the SEACEN Capital Flows Project.
Thank you very much again for Thank you very much again. So we will start the I think a little height adjustment is necessary after Governor Subbarao, who seems... Okay, great. So here we are for the presentation on the book. I just wanted to first begin by again thanking BSP, Assistant Governor Liu, for hosting us, and of course the unbridled support that we have received from BSP, as well as Bank Nagara from AG Fra, who has been behind us always through thick and thin, all of this, and all the member banks who have contributed significantly to this. Not to, at the least, I should mention that there are several authors in this report, including Philip Turner, Andy Filardo sitting here, apart from our own staff, Ole is here, Roger, Victor. But I must say that the production of this book is not an easy task, and I must credit all of that to this guy over there, Roger. He's a production guru. He can have a Hollywood movie or even a Bollywood movie with songs and dance. And so a hand to Roger for doing this. And then I will shamelessly tell you that the book is, you use this QR code to download it from our website, and you will have it. I had a very nice sleep last night because I was trying to read the book. And it's quite soporific, but it can be exciting as well. So thank you again for your attention on this issue. We hope you get to read it. But again, first, why did we write this book? Very quickly, again, as I mentioned, the genesis of this project was when I started at the SEACEN Centre. Governor Veerathai was at the center of this. He sort of wanted the SEACEN Centre at the Board of Governors meeting to provide the SEACEN's perspective on managing capital flows and start research work on this, and that's why we started this. We focused on SOFIs because that sort of is a good set of countries with some harmonious sort of economic structures, small open economies, so that made sense. What we did here was we focused on portfolio flows, not on banking flows. As you will see, since the GFC, a lot of flows of capital to emerging market countries have actually shifted to debt and capital and equity flows rather than the traditional bank lending to emerging market countries. So that's why the focus is that, and the risk at the margin has been rising more related to these kind of flows, and these kind of flows are much more intermediated by the non-bank financial sector. Why is that? Well, because two reasons. Reasons are, one, after the Asian financial crisis, we had a lot of issuance in local currency in terms of bonds, and also from an investor perspective, a lot of investors started to come in to the emerging markets not to buy just dollar-denominated assets, but local currency denominated assets. The original sin to some extent was redeemed in a sense, but at the same time, I will talk about it, there are some issues related to that, and it's called the original sin redux, as Shin and others have pointed out. So this is sort of the genesis of this report, and we tried to use, because this is portfolio flows, there's a lot of market data on it, we tried to use as much high-frequency data as possible to tease out some of the analytical part of this. And this analysis is done largely using what we call capital flows at risk from Tobias Adrian's. We borrowed from the growth at risk literature, but applied it to capital flows, debt and equity capital flows. And we focus on non-resident capital flows. That means foreign investors who are investing in emerging market countries in portfolio flows. That's sort of the essence of it, okay? Just a reminder again, this was a brutal wake-up call for us again, who thought that, well, capital flows, it's not a, it's in the DNA, but of course it's top of mind in the DNA, because what we saw during the COVID crisis as well as in the recent crisis, since the inflation reared its ugly head, we have started to see these kind of outflows, the massive outflows, what we call sudden stops. So this is a brutal reminder that do not forget about us, capital flows. We are there, and we will worry you, will bother you over and over again. So that's sort of the story, the essence of capital flows. Now, we focus on the nature. The nature of capital flows has shifted. As I said, much more market-based intermediation is happening. Why? Because both from the issuer side as well as from the investor side, we have seen a migration to mutually beneficial impact of this. Because from an investor point of view, after the post-GFC period was marked by low yields, so a lot of money was flowing into emerging market countries to get a higher yield. So a lot of this intermediation was taking place through bond funds, through ETFs, through pension funds, through hedge funds, who wanted to invest in emerging market countries. Again, a lot of these investors are not investors that use cash. They are sort of funding their investments using the dollar market. So the dollar market becomes front and center. Even if you are investing in emerging market countries, local currency bonds, you are actually raising your funding in the dollar market. Therefore, the dollar market becomes a big indicator of global liquidity. And that's our indicator in a sense that the risk sentiment, global risk sentiment, moves along with this dollar liquidity. If dollar liquidity dries up, global VIX will show up through lower dollar liquidity, global liquidity. And this global liquidity is something of a big headache for our central bankers, right? Because as it comes in and out, we have large impact of transmission. What is the transmission? The transmission first comes through as you see either interest rate differentials or you see financial conditions tighten. You will see that first impact is through the exchange rate, and for emerging market countries that's very important. The exchange rate depreciates, and as a result the pressure is there for exchange rate to depreciate, and you will, because of outflow of capital. So that's the primary channel of transmission. The other thing that we wanted to point out here is that apart from a lot of these US dollars, the local currency market actually was much more dominated by sovereigns, right? After the Asian financial crisis, we saw Asian sovereigns saying no more of that. We are not issuing in dollars. We are going to issue our foreign currency. We are issuing in local currency. So a lot of foreign investors started to be much more comfortable about emerging market risk and move into emerging markets, not in dollar denominated, but in local currency assets. Okay? But then, what is the problem there? Well, it's a great thing in the sense that you have somehow managed to mitigate original sin, but from a point of an investor, that becomes a similar issue, right? What if the dollar appreciates vis-a-vis the domestic currency? Then, of course, you have a high yield differential, which is your gain in terms of your investment, but you also have another component there, which is the the local currency appreciation that helps you to have higher returns. But if the local currency depreciates, then you have a big problem on your investment. So it turns out that local currency investment by foreign investors has some element of risk, and it has some impact on reserve liquidity and so on and so forth. We can talk about it soon. So anyway, that's the point I wanted to make. And last but not least, it's your old plain vanilla dollar denominated debt that a lot of corporates started to leverage since the GFC, given interest rates, global interest rates were so low. Why would they actually borrow in local currency? They would borrow in dollars because it was cheaper to borrow. Okay, so we see corporates sort of borrowing more in the dollar market, sovereigns borrowing in local currency, but foreign investors investing in local currency bonds. Okay, so let me skip the next one. So these are the broad trends. I must say that this move into market-oriented finance was much more driven by Basel III reforms. Why? Because capital will always move where risk is less regulated. And indeed, with lots of banking regulation, investors were looking at where is more arbitrage opportunities with less regulation being imposed. So therefore, there was a huge increase in the intermediation through the non-bank entities. Okay, and here this picture, I don't know if Nagaraj is watching us, but he is from Standard Chartered, and Standard Chartered Bank was a very important part of this because that conversation helped us, and he has helped us to pretty much draw this this kind of flow chart to show, because for us it's important as you move to the market-oriented intermediation to understand what are the transmissions. Who are the investors? Who are the issuers? How is this money flowing through in the market? This graph gives you, this flow chart sort of gives you an essence of that. And the bottom line here is that you have the governments, you have the banks, you have non-banks, you have corporates issuing, and then you have a whole bunch of investors who could be your active investors with seeking high returns without any constraints. They are the hedge funds and the likes. Then you have cyclical investors who are like the retail investors who come in and out of emerging market countries. And lastly, you have much more the long-term investors, the pension funds and so on and so forth. They all play in this market, and that transmission is important to understand as policymakers. Okay, so the thing out of this is to just understand that there have been an increase in benchmark investors. Okay, benchmark driven investors are the ones that follow the benchmark in the emerging market universe, and they will sort of move their money mark to the benchmark, but of course they will move the benchmark itself will have consequences, because as global financial conditions change, there can be some impact on investors who are using the benchmark to invest. They may see large losses, and they may move money out as they see tail risk emerging. And on the local currency side, what we see is that clearly on the local currency, as more and more foreign investors invested in the local currency, there was a correlation between local currency bond yields and the FX. That's the dollar dominance becoming more and more clear. And again, as I pointed out, for many investors, being in this investment in local currency is actually gives you a higher yield, especially if you're unhedged. Why? Because if you're unhedged, that currency appreciation, local currency appreciation gives you a higher return, right? But of course, all bets are off when there is a systemic risk and global liquidity dries up. When global liquidity dries up, the cost of hedging, you want to get out of the market sooner than later or hedge your investments. There is no hedges remaining at that point, or it's very costly to hedge at that point. Therefore, we see a rush to the gate at that point. If you can't hedge, you sell your assets, and that puts a downward spiral on prices. So this is all sort of culminating to what we call tail risk, right, during stress periods. And a lot of these ETFs, the multi-sector bond funds, and so on and so forth, they are sort of part and parcel of this risk amplification, if you like. Okay. So that's very quickly. I think I don't have much time to go through. I will skip these slides. So this is the one which takes in all this data on high-frequency debt and equity capital inflows from non-residents into emerging market countries, okay? And it sort of maps it to, it's conditioned on global risk sentiment, which is the VIX. And again, this modern art sort of shows you that over time, this actually, it tries to predict 3 months ahead the distribution, okay, using, it's a regression methodology, but a more sophisticated regression methodology. But in any case, the bottom line here is that non-resident flows are tail dependent, but with higher asymmetry towards left tail during global stress periods. During good times, let's say after 2007, you could see that the tail was more to the right, where there was a surge in capital flows, okay? But the point we are trying to make here is that during periods of stress, the outflows can be much more higher multiples of the inflows, okay, given the stock. So therefore, if you are a policymaker, if you're using, just basically mean and median, you are likely to underestimate the risk. And if your policy does not encompass these kind of tail risks, you're likely to have a policy that may not have a great deal of traction in managing capital flows. That's the essence of all of this, okay? So the point is that, in terms of policy, we'll come back to that, is how do we sort of cut the tail? How do we cut the tail? So I've already described this to you, so I won't go into the further details, but I want to give you a flavor of it through a much more real sort of scenario, okay, analysis. So we talk about the dollar's dominance, right? The dollar's dominance and how funding in the dollar market is critical. And the dollar has indeed become some kind of a risk indicator for emerging market countries. So what this picture shows is that inflows of debt and equity into emerging market countries, if you were to condition it on dollar strength, you will see that there is much more tail risk, left tail risk to that inflow, of a reversal of inflow if the dollar were to appreciate, okay? That is the essence of this. The first graph does it on debt, the second graph does it on portfolio equity. And they give you the same message. The blue line sort of says that the entire distribution could shift to the left, and it could be more fat tail to the left. So the dollar's appreciation does not bode well for emerging markets in that sense, okay? How does this risk transmission actually work? Well, very clearly, the one way to think of this risk transmission working is if you look at the third one, financial institutions in emerging markets that tend to fund in the US dollar market become more risk averse, right? They become more risk averse because the dollar has appreciated, and they're, in the sense of balance sheets, if they're operating in lending to emerging market countries, their value at risk or whatever credit models will say that, well, you may not have as much headroom to lend to emerging markets as you had before when the dollar was not appreciating or the local currency was appreciating. So in that sense, credit becomes much more dear, and credit is, they withdraw credit. As a result, you see some financial, further feedback loop into the financial system. And that's sort of the channel of transmission. Now, so that's sort of the analysis of all of this. In terms of the policies, how do we think about this? We thought that, one of the most important part of policy making is the total tectonic shift towards much more ESG type considerations, where sustainability, environmental sustainability, governance, and so on and so forth, social issues are becoming much more important. And we all know from the Asian financial crisis, we all know from the GFC, that when capital flow reverses and it's a sudden stop, it has its social cost through a rapid decline in GDP, raising unemployment, and so on and so forth. Therefore, given that ESG and sustainability considerations are primal now, we need to think through that overarching angle, that indeed capital flows, any kind of capital flows, if they cause such disruptions when they leave, is not an optimal sort of solution for of financing a country, especially in country with current account deficit. We need to think of ways how we can mitigate that risk. So that cycle during the boom, when it comes in, we need to have much more of a counter-cyclical policy mix that will reduce the amplitude of that cycle, so that on the way up you do not build those excesses, so that also at the same time you can draw them down during the down cycle. Okay, so that's sort of the essence of this. So we talk about how the social effects of capital flows and the role of imperfect markets. That's very important, because emerging markets are not deep. Emerging markets are not very liquid, especially during times of stress. They may be liquid and reasonably deep during peace times, but during times of stress, they are much more violent, and what investors are doing is trying to just get out of this market. They are looking for liquidity to be able to sell. So that creates this, 5, 6, 7 standard deviation moves in yields or in equity prices during times of stress. How to manage that? To manage that, this externality of the social cost from such reversals need to be part of public policy, and it needs to be internalized as public policy. Okay? So in that sense, we need a much more holistic framework. We need a much more holistic framework because financial market constraints can have imperfections in emerging markets in amplifying such cycles and such. So we need some insurance on capital flows. We need some insurance on capital flows. And the current policy framework is evolving, and this is what we have suggested here. Is again, it's a constructive thought of many minds, and it just sort of says that, look, this is soul searching, but at the same time we can provide you some essence of what this conceptual framework and a more practical way of implementing it can be. So in that sense, foreign exchange, a monetary framework or a framework that manages capital flows should, in its design, consider that foreign exchange intervention is part of the DNA, because financial market frictions within the context of emerging markets can be destabilizing and can actually have social costs. Therefore, FXIs can actually be more optimal in a welfare-enhancing way. So FXI are just not technically things that you use, but its use as a policy instrument is much more broader than that. Then, of course, you have macroprudential measures. We know from this current episode that systemic risk is not easily measurable. It is much more amorphous. It's not like inflation. You cannot say that, between 2% and 6%, if my inflation goes up to this, we are going to raise policy rates sooner than later. Macroeconomic financial risk, systemic risk is much more, it's much more difficult. It's to make it time varying and rules based. Therefore, macroprudential policies have to be much more forward looking and preemptive. Okay? And what we also say is that, as this morning we discussed, that capital flow measures should not just be the last resort, but capital flow measures should be part of the broader policy toolkit. Okay? Capital flow measures are very important because a lot of these macroprudential or systemic risk that emerges in emerging markets is rooted in cross-border flows. And if it is rooted in cross-border flows, there is no other way but to use a combination of macroprudential and CFMs to be able to manage them, especially in the context of significant portfolio flows that are creating huge disruptions in your valuation of your markets and creating excesses in those markets. So a combination of MPMs and CFMs make it easier to achieve multiple goals such as price stability, financial stability, macro-financial stability, and a sustainable external position. And it helps you to manage the complex trade-offs there are. Okay? So here, the next one is sort of how do we conceptualize this in a much more, tractable way. Here, I must credit my good friend Andy Filardo and his contribution in this. Andy was critical in this part of the study, where he helped us with this beautiful figures and spider charts and so on and so forth. But in essence, I will try, and Andy will say more about this during his session. Just in brief, the idea is that the current policy framework has to evolve to bring in the broader economic considerations. Central banks in the SEACEN jurisdictions have actually been practicing that in some sense. They have not just relied on this very narrow inflation targeting price stability mandate. They have actually expanded from that. And the next chart really shows you that yes, post GFC, many of the central banks and financial regulators adopted a more broader set of policies where financial stability became part and parcel of the monetary framework. But the SEACEN central banks have put this into practice longer than one could imagine. So the practice is sort of ahead of the theory, because you know that the IMF and many other, and the BIS, they are sort of working on various aspects of the integrated policy framework, which brings in interest rate policy, financial stability policy, and FXI and CFM and MMPM together in a theoretical sense, and then how to bring it to practice has been in the preserve of SEACEN economies already. So the idea here is, you get the idea, right? I mean, the idea here is to say that, look, going forward, this framework will have to think about multiple issues. Central banks will have to think about not just price stability, not just incorporating financial stability into it and making capital flows much more front and center here, making it less disruptive through various innovative market-friendly instruments, but at the same time be aware of digitalization, climate change, inequality, and the likes. Well, that's more for the future, but at least we need to work towards that, because the world is going to look very different as we go forward. But of course, as pointed out earlier, that this is easier said than done. As Governor Subbarao and Governor Veerathai pointed out, implementing some of these things, it's nice to present, but implementing these things is difficult. So what about implementation? Well, we thought, this is again Andy's invention, and the tail risk was brought in by us, and Andy sort of incorporated that into this perspective 3, where basically if you think about a Taylor type rule, you integrate capital flow risk management into a policy framework, and you can operationalize it by thinking about this equation. I think Andy will be better placed to explain this, but it basically is a Taylor type equation where FXI, foreign exchange, is part of your monetary policy framework, including interest rates. And where you look at your inflation gap and you look at your output gap, at the same time you pay attention to the exchange rate, as well as you have an element of tail risk embedded into this equation. So this is sort of our last word on how to operationalize in this. But this is something hopefully will propel a whole bunch of studies that we can use this data and some parameter estimates to see if this perspective 3 can actually be operationalized in reality. So that's it for me, but just wanted to again go back to this to say that, well, policy mix needs to address cutting the tails. Cutting the tails is very important in the context of a complex world. You have to be much more flexible. Of course, we learned today that flexibility is not that easy, but having the suite of instruments, having the mandate can give you that flexibility. I mean, think about it. Emerging markets going into the bond market, into the sovereign bond market, even corporate bond market during the asset purchase program, with Laura Kodres will talk about. She has authored this fantastic study for SEACEN on asset purchase programs. The counterfactual is tough to prove, But clearly, the asset purchase program gave the central banks the flexibility to come in during the stress period to intervene in the bond market. And Bank Indonesia is sort of in the league of its own in terms of how they use this trifecta of different policies, tools to manage financial market distress or financial market turbulence. So I think this is very important, the flexibility, and of course putting a premium on resilience, which is having policy buffers to build resilience, which is over and again we hear that. But one important thing that we would like to highlight is that being preemptive is very important. Systemic risk is hard to measure, so therefore being preemptive is much more suited to amenable policy, distress later on, market distress later on, than actually stopping the flows at the gates when they come in, to say that, well, these kind of hot money flows are actually not suited to or well suited to our economy, and we will maybe put some kind of a market-friendly measure like a tax or something like that to disincentivize too much of this kind of money. So it has to be much more proactive, much more preemptive, and it has to be deliberate, because these are, financial stability has to be part of the DNA, has to be hardwired into macro-financial stability. And adopting this counter-cyclical safeguards is very important. So flexibility, again, dealer of last resort, this is what the APPs are all about. Central banks are not used to, this kind of balance sheet expansion where, especially in emerging markets, where they go out and buy sovereign bonds from the private sector, from the financial institutions. But the crisis has shown us that that cannot be ruled out as part and parcel of your toolkit. So with that, let me stop there, and hopefully I've not eaten up too much of my time here, but it's 11:02, so I think hopefully I'll stop there. Thank you. Thank you very much.
Our second panel will discuss the emerging trends and challenges of capital flows in Asia and Pacific economies. This will feature panelists who are experts in their respective fields. Let us welcome to the stage Dr. Ole Rummel, moderator for this panel, and the rest of our distinguished panelists. So may we request our speakers to proceed to the center of the stage for a quick photo.
Good morning, everyone. Mahobay and magandang umaga to everyone in the hall. And welcome to the second panel of the morning on capital flows in Asia and Pacific economies, emerging trends and challenges. I realize that we have a tough act to follow from the first panel this morning, but I have full faith and confidence in the Avengers that I have assembled here, the five Avengers that will join me this morning. So how do I know that I have a very distinguished panel? Well, the biographies run to several pages. And I think we could use the entire time just me reading off the many accomplishments of our panel. Let me just say a word about this morning's panel. I was worried a little bit. We have the SEACEN Centre is organizing a capital flows course next week in Manila, and so I'm staying here over the weekend. And I was a bit worried about how I would occupy my time, but now, given the presentations we've had this morning by Governor Veerathai, Governor Subbarao, and Dennis, I'm going back to my slides, and I am redoing a lot of my slides for next week's, for my presentation next week. Let me be very brief in terms of introducing our speakers. So, for example, we've heard Mangal twice, but he hasn't been introduced at all. But obviously, he is the executive director of the SEACEN Centre. Before that, he was deputy director of the IMF South Asia Regional Training and Technical Assistance Centre, and before the deputy director of the IMF Singapore Training Institute. And he's been with the fund since 2001, I believe, since 2000. Then we have Andy Filardo, who is currently a visiting fellow at the Hoover Institution at Stanford University, well known to the region as well. He worked at the BIS until a couple of years ago, including the head of monetary policy, and prior to that, head of economics for Asia and the Pacific in the representative office of the BIS in Hong Kong. Then we have Professor Laura Kodres, who is an associate and the former distinguished senior fellow for the Golub Center for Finance and Policy at the MIT Sloan of Management. Laura has a long and distinguished career in public service for a number of institutions, and I was very overwhelmed by her experience in a number of regulators. So for example, this CFTC. She's also served on the Board of Governors of the Federal Reserve, and a long career at the IMF, including division chief for the Global Financial Stability Analysis Division, where I met her in a long time ago in a galaxy far, far away, and I'm very happy to see her again. Are you all awake now? And then finally, last but not least, James Yetman, a good friend of the SEACEN Centre, who currently works as a principal economist at the BIS representative office in Hong Kong. LinkedIn just told me that he's been there for 15 years right now, so this is a major accomplishment. Before that, he was in academia and also in central banking, so he's one of ours. He's a true blue or whatever color we choose. And joining us virtually from Singapore, we have Nagaraj Kulkarni, who is the co-head of Asia Rates Research and head of Flow Strategy, and he has a long and distinguished career in banking, and particularly in analytics, structuring, and trading, so he will provide a very valuable market view to our questions. Let me just do a quick check. Nagaraj, can you hear us?
Absolutely, Ole, thank you. Okay,
thank you, Nagaraj. So let me, I have a question first for all the panelists, which is based on the recent work on capital flows, more particularly some of the recent trends in capital flows that you think warrant more attention in the context of policy considerations. We just had a couple of slides from Edie Mangal, and in the book we highlight the volatility of portfolio flows during risk-on and risk-off episodes, i.e. the search for yield or the flight to safety, and given the international financial market architecture. So for you, what patterns or trends do you see that warrant policy considerations? And I'd like to start with Laura, if I may.
Thank you. And thank you for inviting me for this wonderful panel. Let me iterate some of the themes that we've looked at this morning, and the one that probably worries me the most in terms of trends and patterns that warrant some policy response is the increased activity of non-bank financial institutions. And within that very broad category, I would highlight asset managers, and within asset managers, I would highlight the new increase in retail investors. I think we are not sort of acknowledging that asset managers are no longer the rich and famous and the pensions and the insurance companies working through asset managers, but the growth in what I would call retailization is taking place. And these particular investors are less experienced, and they are likely to pull out in mass. We saw this with the Silicon Valley Bank recently, and I think we're likely to see it again and again. And we saw it a little bit during COVID. So I think that's an area where the influence of social media, the influence of the ability to rapidly exit ETFs, and on the other side, some more illiquid activities, some illiquid assets, is going to be very problematic. The second area that I would highlight that is worrisome is really the unsettled policy environment, where specifically there's a lot of overall uncertainty about how monetary policy is being conducted, what the transmission mechanisms are, whether they're the same as they used to be, whether large advanced economies are moving at different paces, are moving at different sized units of increase, and whether that matters in this region in terms of how that transmission mechanism, both from a domestic point of view and also a global point of view. So those would be the two places I would highlight at the moment.
Thank you, Laura. Can I call on Nagaraj virtually in Singapore for his contribution?
Good morning to you all, and thank you very much, Mangal, and the panel there for having me. It's quite interesting that you mentioned risk on and risk off, and I was just having a chat with Mangal a few days back where we did some empirical analysis on what drives flows, and we did a principal component analysis, and the first principal component was about risk on risk off sentiment, and we have tried to correlate with wicks and move indices. So it's quite sort of interesting to me that Mangal and you are sort of looking at risk on and risk off sentiment. So there's actually a sort of empirical evidence for that over the last good 12 years of data. So let me highlight sort of three things more from a practitioner's looking at. If I take a step back and look at where we are right now, COVID was the second largest exogenous shock to the global economy after global financial crisis, and I'm referring to the financial conditions here, and the ongoing monetary policy tightening which we have seen since last year in US, in Europe and elsewhere, is leading to sort of the third largest sort of tightening of financial conditions. That is mainly engineered by the central bank. So the volatility of financial conditions which we are experiencing is pretty large and unprecedented. I would say you just have to go and look at the financial conditions indices during the small banking stress in the US. So that is sort of underlying tectonic shifts are quite massive, I would say, and amid this kind of a backdrop, three things I would point out. One is just corroborating what Laura already mentioned on the monetary policy. How do we exit from ultra loose monetary policies while preventing accidents? We have not experienced this level of policy rates for close to 1.5 decades now. probably highest rates since 2005. So how does monetary authorities exit this kind of situation and at the same time avoid accidents? Second, for the EM world, as we speak, the interest rate differentials have narrowed significantly. You know, U.S. Fed has hiked by 500 basis points. How much has the region or sort of country, emerging markets have hiked by? You know, LATAM has hiked much more, but Asia not as much. China is on the other end of the spectrum. It's looking to sort of ease monetary policy. So in such a situation, it will be hard for emerging markets to attract capital because interest rate differentials have narrowed. And this is a question for fiscal authorities on what are the alternative sources of financing. So this is the second trend. The third, which is increasingly becoming important, is that geopolitics as a driver of flows and not economics as much. You know, the real economies have fragmented. COVID has showed us the disruptions in the supply chain, and that has led to sort of asynchronous growth. There are economies which are sort of behaving in not such a correlated manner, and that will have spillover onto financial markets as well. So that is the third point which I would sort of emphasize. The first one, monetary policy. Second one, the narrowing interest rate differential, and how do fiscal authorities go ahead and finance themselves in absence of foreign inflows. And third, geopolitics and not economics. So I will stop there and back to you, Ole. Sorry, it's not audible.
I just want to highlight a couple of things that did really resonate as being very similar. And one was the dollar as a barometer. We had a very clear presentation from Mangal just now of the original sin redux channel, which we found very important in our work. And I think you explained very clearly how that works. And similarly, another thing that the report talks about in detail is the role of institutional investors. When they're from outside, they tend to be destabilizing. When they're inside, domestic, they tend to be stabilizing. And so what that speaks to is the key importance of hedging and understanding hedging in our economies, which brings us to how much surveillance and monitoring we can do of these key variables. Monitoring hedging is something which I think can be very difficult, and yet it's a key ingredient in how we react as in the policy community. I also liked how in the report there's a lot of focus on the risk-on, risk-off cycle and how that feeds into investment flows. That's again something we've focused on a lot in our work. So in the risk-on stage, obviously the goal is to build buffers with the FX reserves or ensuring that banking systems are very robust and to prepare for the inevitable downturn. And then when it's risk-off, well, hopefully those buffers then give you some insulation. But if they don't, you have those buffers that you can put into use to improve outcomes for the economy. One of the other things I found interesting, which again resonated, was that FX intervention is becoming less frequent as a tool and more geared to concerns about financial stability and market functioning. So markets, if you like, are increasingly left to their own devices, although as Governor Subbarao mentioned this morning, there might be a bit of a gap sometimes between the theory or the talk and the actions that we need to keep an eye on. But all this acts in a regime where there are many other tools we're also using, and those tools are expanding, whether it's QE within the region or Operation Twist type measures. So managing these conflicting, potentially, set of tools together can be very a demanding challenge going forward. So let me leave it there.
Great, thank you, James. Let's ask Andy about his views.
Well, I'm going to stay pretty narrow in my responses to address the exact question, because I'll talk later about the monetary policy environment. No, it's working. It's working? Yeah. But first, I'd like to thank Mangal and the SEACEN Centre for inviting me to participate in this event. I'd like to thank Senior Assistant Governor Sicat for the great hosting. When I was in the Hong Kong office, and I was always when I was invited to a BSP event, I always knew we were going to be taken care of. And the prospect of coming out here and this recent trip just made me very happy to be here and experience this hosting. Thank you very much. The panelists have already said a whole lot about what's going on. I just want to focus on where I think the biggest challenge will be for you in the next, say, several months, and what you should be looking for out there in terms of the source of capital flows that may come here and the ones that may draw outflows out of the region. And that's to look at banks, not just in your own economies, but around the world. Banks right now are facing a new environment of high interest rates, and to the extent that they have weak balance sheets, and it may not be the whole banking system, it may be a small sector of the banking sector that goes down in one country and can have reverberations and contagion to other areas. Now that, as Mangal pointed out, these bank flows are not necessarily the most dramatic or most disruptive flows. But banks, of course, are connected to these non-bank financial institutions in various ways in terms of providing credit. And so you could have this super multiplying effect. So I would think that the causal effects or factors that may be behind big capital flow movements over the next couple months will be from the banks. You might get some early indicators by looking at bank data. But then when you want to look at the multiplier effect, you're going to have to look at these non-bank financial institutions.
And last but not least, Mangal.
So I'll be very brief because you've already heard from me. But I think, you know, what Laura pointed out and Andy, NBFIs are key and to the risk issue. But I think there are three risks. One is liquidity, the second one is liquidity, and the third one is liquidity. There are three risks. I think right now, liquidity risk is primal on minds of investors, on issuers, on policymakers. I'll give you an example. If you are an investor, pension fund, or an asset manager investing in emerging market countries, during the good old days after GFC, you thought, oh, this is beautiful that I can invest in a fund, emerging market multi-sector bond fund. On a daily basis, I can redeem my money if I don't feel right. But the point is that the liquidity behind these investments, they may seem like you're investing in a stock market in your own country, but they are not. Because the underlying instruments in these are emerging market bonds. And these bond markets can become very quickly illiquid during times of stress. So if you do not have the ability to withdraw from these markets timely, you start to worry about putting more money in during good times. So I think liquidity risk is a key issue here, and it's further amplified by this move from massive QE to massive QT, or you can frame it, the normalization, and that, as Andy pointed out, will reverberate even in the bank's balance sheets, because the sovereign bank nexus may rear its ugly head very soon, because if banks indeed have bought a lot of government securities or the likes for their portfolios to enhance their risk management or to boost their capital adequacy ratios, they are likely to see this kind of nexus becoming much more onerous given debt levels are high. So both liquidity, addressing liquidity from a policy perspective through various instruments. Now we know that a one-year repo window has become pretty much a normal thing rather than a one-day repo window. So these kind of liquidity instruments to safeguard systemic risk from unfolding is going to be also an important thing for policymakers' minds.
Okay, thank you, Mangal. We had two meetings yesterday where we got together for the first time in person for about 4 years. So it was great to see so many friends and colleagues at these meetings yesterday. And we tend to forget that some borders only reopened like a year ago, so it hasn't been there's a scarring of there's been an easing of COVID-19 restrictions only recently, which made me think about the pandemic. And let me ask Laura a couple of questions, who has just finished a very interesting, very helpful research project for us on asset purchase programs in the Asia and Pacific region, which will be published very shortly. And she looked at 8 countries in Asia Pacific, including 6 SEACEN members. I just wanted to ask Laura about the motivation and some of the results in her study.
I have just a couple of slides, maybe. This is automated, yes. So there, yes, thank you very much. So yes, I had the privilege of being asked by Mangal to pursue this idea, and I gratefully did so. I think the motivation for looking at asset pricing programs in the region is that twofold. One is that they're different than the advanced economies. The motivation in this region was predominantly about reducing the volatility of government yields, not so much to do QE in another form. Because, in fact, most of the interest rates were above the zero lower bound, so it wasn't necessary to use these for the purposes of trying to influence monetary policy. So let me just summarize the results very quickly. There were 8 countries in the study, 5 emerging markets, 3 advanced economies, as Ole pointed out, 6 SEACEN members and 2 broader SEACEN members, I was told. The goal here was to look at lower government bond yields and whether they stabilized. There were a couple of other variables I put in here to see what the impact was, and you can read the paper to examine those. 3 methods were used. Simple event study, which is very common amongst people looking at events such as the announcement of an APP or an announcement of anything. My feeling is that event studies are very good to do as a first cut, but they don't control for anything. So you don't know whether or not what happened was actually due to the event that you are examining. So the second action was to involve other influencing factors, which include the Federal Reserve's policy rate, the local domestic policy rate, the VIX, and the exchange rate. So controlling for those items, do we still see or can we see some influence on government yields? And lastly, it's a dynamic situation. Not every country implemented one of these at the same time. Moreover, having implemented one in one country, another country might be more apt to implement their own APP type program. And so, there was an influence in terms of looking at these across the countries, but then being able to express or look at the dynamics among them. So a last technical statistical theory was used to look at that. So the results on average is that all 8 countries saw some reduction in the yields, and all of them showed a reduction in the volatility of the yields. This is the first event study. It just looks at the emerging market countries. There was a decline of about 31 basis points across the first 10 days following the announcement, most of which came from day 2 to 10 or 2 to 7. Notice the very large boundaries with the dotted lines, which are the interquartile range. So none of this is sort of significantly statistically different than 0, and part of that is there aren't enough data points to even talk about statistical significance here. But I just wanted to note that because that's in contrast to the next picture, which shows the 3 advanced economies, Korea, New Zealand, and Australia, where you can see a much more abrupt decline in yields, something on the order of 46 basis points, and a much narrower interquartile range, which means that they were sort of more consistent across the 3 countries in being able to reduce. So at least we had something to start with in terms of doing more sophisticated work. This more sophisticated work is represented here. Here is the 10-day impact of an initial announcement, which is a panel result, but then each one of these countries has their own predicted value. And here I would note that every single country on the day of their announcement saw a decline in yields, and all of these countries also saw a diminution in the volatility following the announcement. So from this perspective, I would say that this was a successful project. Even when you take into account, again, all those controlling features and now the dynamic changes across them, both leads and lags, you see that there is still a decline in yields, which is, in this case, statistically significant. Not a huge decline, only a few basis points, but again, it was in the right direction and it was statistically significant and not inconsequential. So the next part of this paper, which you were going to ask a question about, but I'm just going to bowl ahead, is that the paper talks about communication, and expressly. I mean, it's not like behind the curtain here. It's actually in the paper, and we talk a lot about exactly what best practices are. Keep in mind that an APP in this region was not normal monetary policy. People read monetary policy communications after a monetary policy meeting, and there is an art form at deciphering what exactly the governor said or the policy committee said. This is new territory, completely new territory, and it was happening in real time in a crisis. So even more important that the initial announcement be accompanied by some type of motivation and goals, but importantly, I think, especially in these crisis situations, and especially in one that's not actually driven by the financial system, that it leaves open the length of time that one is going to employ them, and what are the specific measures of success. I think it would be a mistake, and I think most central banks thought it would be a mistake, to ask how many basis point reduction would have constituted a success of this particular policy. Important to keep this open. Whether or not announcements should be joint between a Ministry of Finance and a central bank is a little bit dicier. I would say indications that the support of the government is there, that fiscal and monetary policy are working together is an important component, but do they need to make this announcement at the same time? Not necessary. Programs should begin shortly after an announcement, within a day or two. If you announce something and you're only going to implement it a week from now, people are going to start to position. We've already talked a little bit about how the market can anticipate, and you want to be very quick to implement something that you say you're going to implement in this area. The execution details have to be clear. People have to know if they're bidding for government securities, how it is that they're going to do so. Fortunately, most central banks deal with a set of counterparties in open market operations, and those are the same counterparties that will be used in such a purchase program. But it needs to be made explicit, and if there are special attributes to this kind of program, one needs to be very clear about what they are in order to generate the demand, in order to generate something that's going to be successful. And lastly, ex post transparency is important. Often, there's a predilection to not disclosing what it is that you bought and what price you paid if you're a central bank. In this case, noticing how much you had to pay and what the price was will be important, because it'll signal how important the central bank takes this policy, that it's willing to put on paper, exactly what it bought and what it paid for it. Now, if it's not sufficient and the price was, not to the liking of the central bank, that is also a signal that they need to do better sort of the next time they intervene. So even if it doesn't seem like it's the right answer, it needs to happen. The last part of this paper talks about exit. It's one thing to enter, it's a lot different to exit. And so the exit policies that are sort of considered the right way of doing it still follow the playbook of the advanced economies. First is to taper any purchases. The second is to stop the purchases. The third is to use regular monetary policy. And then finally to decide how much you're going to exit of the existing bonds that are sitting on the portfolio. Again, it's important to make sure that you're very clear about what it is the objective is. Remembering that, of course, exit means that you will be increasing the liquidity in the markets, and so one needs to be careful about what they're doing exactly there. I think I had 2 more slides in case they're not up and running. Makes it easier for you to listen rather than just hear me verbalize. So obviously you had to have an internal game plan. One less than this. The internal game plan should be very clear. It doesn't need to be expressed. I think, a couple of people have intervened to suggest that the internal plan need not be a public plan. And it might be by giving your hand, you will unfortunately give the markets a chance to accommodate you, maybe in the wrong way. One needs to acknowledge that you might need to reinstate the APP. Korea did this last September. The UK did this September, October. Very explicit about what it is that was leading to the volatility that they wanted to prevent and what the conditions are for exiting that. I want to make one comment about rolling off the debt. Usually the idea is if we can just let it roll off and if it needs to be reissued by the government, fine. The problem is that most of these purchases were long-term, and so waiting 10 years to roll off your balance sheet is a bit long, particularly if the credibility of your central bank is not 100%. So picking and choosing what maturities you want to sell in the marketplace is very important. People think, well, we just sell what we bought last, or first in, first out, or some other thing. Think carefully about who the borrowers are of the maturities that you're going to sell. If you're going to sell long-dated maturities, it's going to affect those borrowers that use that rate. Maybe they're mortgage holders. Maybe they're long-term infrastructure loans. If you're using shorter-term debt, maybe those are SMEs. Maybe those are other types of funds. So be careful about which part of the yield curve you decide you want to make sales. And then, be cognizant that what is the global environment? What is the local trading environment in which I'm releasing these? If it's volatile, take a wait and see. Don't do it immediately. And lastly, just let me mention a couple things about the impact on capital flows, given that that is the subject matter of this particular discussion. I think it's important that one recognize that when you reverse one of these asset purchase programs, you are essentially reversing what you did in 2020. You are, instead of buying debt, you're releasing it. Okay, so as you release it into the economy, you have to accommodate the liquidity constraints. And let me just echo Mangal's point about it's all about liquidity, liquidity, liquidity. And so, this is a component of liquidity, and it could be lumpy. So you'll need to think very carefully about, how it is that you're going to accommodate that, particularly in an environment in which the liquidity is being used in the FX context, right? So again, you need to pay attention to the appreciation pressures that you might be inducing, what that might do for capital inflows, whether or not that should be paired, whether the FXIs should be paired with the bond purchases, and if so, whether those should be announced or unannounced. I see 2 angles here about how APPs will affect capital flows. One is that if outsiders view the central bank as being interventionist and likely to do random things, that might lead to less interest in the local economy. So that would be sort of the negative view. The positive view would be, look, this government was forthright, or the central bank was forthright, it was limiting the volatility of its markets, it's making it safer for me to invest in government securities, local denominated government securities, and I'm more likely But keep in mind that's a double-edged sword, right? They may be more likely to bring in inflows, but only because they think there's a backstop. So it has this moral hazard component kind of in the background. So here, those are my thoughts about how it is that this program might affect capital flows and FX. And I guess my bottom line is to always pay attention to the markets before you try to initiate an exit, and consider all of the repercussions that you can think of before you step into that market.
Great, thank you, Laura. I'm going to embarrass her I've now read the paper several times, and it's an incredibly rich paper. As you saw, it's not only about the effectiveness of asset purchase programs in the region, but also about the tools and the implementation, and as we saw, also about the communication and the exit. So I very much regard it as a go-to place, or a how-to guide. In essence, if you are ever interested in undertaking asset purchase programs, this will be the point of departure for all of us. On a sort of in a similar vein, James, you did some work at the BIS on central banks' monetary policy responses to COVID-19. And recently co-authored a study on inflation, which obviously is a concern for central banks in Asia and elsewhere. In your study, you differentiate between low and high inflation regimes and the impact of monetary policy action. Would you like to elaborate a bit on the motivation and results of your paper?
Sure, thank you very much. Yeah, so this is a paper I co-authored, BIS Papers number 133, with Claudio Boria and two other of my colleagues. So it's sort of easy to forget the history of high inflation in many advanced economies. You've got to go back to the 70s and the 80s and think that high inflation is really an EME, or developing economy, problem. And of course, that would be a big mistake, right? The last 2 years have shown us that. In fact, many SEACEN members have had enviable inflation performance compared with their advanced economy peers in the last couple of years. So what matters for getting high inflation? Well, clearly it's not about the development of the economy. It's not some per capita GDP metric or anything like that. Instead, it's something about market psychology, or psychology of people in the economy and how that can change. And that's what our study was trying to focus on. So something changed towards the tail end of COVID, and we can discuss why that was, excessive fiscal policy or whatever. And then we had the war in Europe and large inflationary shocks. But inflation started to look in many advanced economies like it lasted 30 to 40 years ago. And more recently, fortunately, things seem to have turned, but whether they've fully turned or not, are we out of the woods yet? Well, I don't think any of us really know, but perhaps we are, hopefully we are. But our paper, if you like, highlights some of the reasons why we might want to worry that maybe there's still more to come. So the idea is that there's two regimes of inflation. In one regime, inflation is low, and it tends to stay there. It's low enough that it's sort of unimportant for decision making. Consumers don't really pay attention to it because it's not an important input to their decisions. Firms don't either because they have limited bandwidth, and there are other things that are more important. So the idiosyncratic costs they face to their input costs or whatever are more important than headline inflation. And so inflation kind of slips under the radar and doesn't matter for their decision making. Now, we compile a bunch of empirical evidence that's kind of consistent with this way of thinking. In a low inflation regime, we kind of think of inflation below 4 or 5% as satisfying that, then inflation doesn't tend to be persistent. It also doesn't tend to pass over from one sector to another. And further, spillbacks between inflation and wages and prices, and from prices back to wages, tend to be very weak. So things are fundamentally quite nice, if you like, in a low inflation regime. In a low inflation regime, inflation just doesn't matter. But of course there's another regime, and that's the high inflation regime, and all that stuff goes into reverse. Inflation's in the news, it gets the attention of people, it becomes relevant for decision making, so decisions are made differently. And that alone means that inflation is going to tend to be persistent. It's going to tend to spill over from one sector to others. It's going to spill over from wages to prices and prices back to wages, which is the definition of a wage price spiral. And that's a problem then if you're a policymaker, if you want to achieve some inflation target, 2% or any other number for that matter. Now, our cutoff there is not particularly high inflation. We're not talking hyperinflation here. We're talking inflation above 5%, is where we start to see these factors empirically very strongly in the data. Now, we can't prove it, but we think that something that's behind it could be that inflation, headline inflation, starts to play a coordinating role. That is, it's something that everyone's aware of, and you're thinking about how much to raise your price by, and everyone knows prices are going up by 5%. So you raise your prices by 5%, and that becomes self-fulfilling. It's a coordinating device, and so wages and prices tend to track the headline. And so this enters the psychology of decision makers in the economy. All right, so that will be a challenge, of course, and that might be the challenge we're facing. So what are the implications then for policy, since this is clearly what we care about here? Well, in a low inflation regime, then we would say authorities can probably back off. Inflation is unimportant to consumers, it's unimportant to firms. Maybe it should also be relatively unimportant to central banks. I realize that could be a provocative statement. But what do we mean by that? Well, even if inflation was lower than the target, then maybe the macro costs of that are also low. And this was something that Governor Veerathai was commenting on before, not doing too much when inflation is uncomfortably low. I mean, authorities might be tempted to react strongly to avoid a deflationary spiral. But we know from history that deflationary spirals are actually surprisingly rare. And when they happen, like during the Great Depression, 100 years ago almost, we can see why it happened, and that was because monetary policy was much too tight. And it's not clear, it's clear what the solution to that would have been, a very different monetary policy stance. So in the lower inflation regime, then the risk is that authorities will do too much. And we would suggest not just when inflation is lower than target, but also when it slips a little bit above target. Because given what I've told you about the nature of inflation in a low inflation regime, it will tend to fix itself. It won't tend to persist. It won't tend to create a long-term problem. Low inflation, authorities can relax. But the high inflation regime is the exact opposite of everything I've just said. In the high inflation regime, well, we know authorities are going to have to react strongly. Now, fortunately, we know what they have to do, right? We know how to get inflation down, but it can be quite costly in the process. In real time, though, we don't know what regime we're in, right? And even now, are we in a high inflation regime? Well, it's not really clear. It's a threat. But even when it's just a threat, even if we don't know, then the more it becomes a threat, the more it calls for a much stronger monetary policy response. So I'd say it's not clear if we've transitioned. We're at risk, at threat of transitioning in many economies, more so in the advanced world than in the emerging world in general. But clearly it remains a threat even now. And while authorities have done a lot in terms of policy rate raises, we still don't know if it's enough or if that threat remains. I'll leave it there. Thank you.
Great. Thank you, James. Obviously, a lot of food for thought here. We're talking about inflation, and let me return to Nagaraj in Singapore to get the market's view on this. Because most central banks are facing the challenge of taming inflation using interest rates. So I'd be interested in sort of finding out what the market's take on this is. And also, if you had looking into your crystal ball, do you have any sort of predictions for the patterns of capital flows, particular portfolio flows that you foresee in the short term?
Sure, Ole. I think as far as inflation is concerned, it was very confusing to the markets at the beginning, because the inflation dynamics which resulted from this pandemic were very, very different and unprecedented. There were supply side factors, especially with supply chains getting clogged and that leading to inflation. There were demand side pressures when economies reopened from COVID. It was unprecedented sort of travel reopening and sort of vengeance spending, not very usual, right? So it was pretty confusing for markets, and I believe it was equally challenging for the central banks to decide on when to actually start responding. So what we have seen in this cycle is markets obviously trying to price in the rate hiking cycle well good six to 9 months before actually the hiking cycle started. So we have now come to a stage where markets believe that central banks are close to end of the ongoing rate hiking cycle. Markets are looking at month-on-month decline or month-on-month changes in the inflation. They are not as strong as they say about six months back. So there is a lot of comfort which markets have drawn from this rate hiking cycle. The second bit which I would like to sort of highlight is what is happening to the liquidity. By liquidity I mean the amount of US dollars which say US banks still place with the Fed. That is still close to $2 trillion, which is a consequence of QE programs. We know that ECB and Fed have started to contract their balance sheets, but still, even today, there is $2 trillion worth of US dollars getting parked with the Fed by the banking system. So, does this change or reduce the impact of monetary policy tightening on the real economy? So, that is something to take note of. And let me link that with what kind of flows we are seeing or what we are expected to see. Now, if I look at the flow dynamics, there are very interesting things which we are observing right now, which we have not observed for the last 15 years. First, because the policy rates are so high, like 5% in the US, the money market rates, which are basically instruments which yield like 3-month T-bills, 6-month T-bills, they have gone up all the way up to 5%. Now, if I'm, as an investor, getting 5% on US money markets and some other emerging local currency bond is giving me, say, a pickup of 200 basis points, then the bar for me to move out from the US money markets into the rest of the risky assets is actually really high. So what we have seen is enormous amount of inflows into the developed market money markets. And not as much in the risky assets. So that has been the trend even during COVID. This happened during COVID because of risk aversion, but right now it is happening for a different reason. It is happening because money market rates are really attractive. So this has somewhat reduced the flows into the risky assets, be it debt or equities. Now, quickly looking into the next sort of 3 to 6 months, financial sort of the flows into risk assets are really dependent on financial conditions, and rate hikes, liquidity, withdrawal, balance sheet contraction, all these lead to a tightening of financial conditions, and that is not good for flows into risky assets. So as we sort of reach the peak of policy rate hiking cycle, as we end this financial conditions tightening episode, markets will look ahead and say, okay, we are now done with this. Probably we are looking at a rate easing cycle, or at least financial conditions easing in one or the other form. So that should lead to inflows into risk assets. So last 2 to 3 years, EM debt, specifically because I think a lot of speakers focused on the local currency debt and hard currency debt, the flows have been very minimal. In fact, we have seen outflows of about 7 to 8% of AUM last year from the EM hard currency, local currency debt. Flows have not come back because financial conditions were tightening, but going ahead, we do see that as financial conditions ease, inflows might again come in over the next 3 to 6 months. So I will leave it there. Ole, back to you.
Okay, thank you, Nagaraj. I have a question each for Mangal and for Andy on policy frameworks, and then I would like to open it up to the floor, and we have microphones in the aisles. So if you have a question, please make your way to the microphones that we've made available. Mangal, if I can start with you, and then it's a sort of a two-hander, I think. And in the book, we highlight policy frameworks and policy tools used to manage volatile capital flows. Could you expound more on the SEACEN's perspective on both and how different they are from other proposed frameworks?
I'll just take a very quick few minutes and then pass it on to Andy, because I've talked a lot. So I think one of the key differences in our sort of conceptual framework is that, well, if you look at the whole complement of instruments and policies, clearly macroprudential policy and capital flow management policies are very intertwined in the context of emerging market countries, given the cross-border nature of flows, which may become systemic both for domestic reasons as well as for reasons that are because of the inflows coming from abroad. So I think the role of CFMs as being part of the broader toolkit becomes an important sort of advancement, if you like, or audacity, if you like, in that sense. So that's the biggest difference.
Yeah, and then my question to Andy, who's been very patient, is following on from that, in terms of central banks have very clear mandates, but there, as we saw in the spider charts, there are other important considerations. We had volatile capital flows, we had climate change risk, digitalization, and others. So what is your view on central bank mandates and policy frameworks in the context of these evolving considerations?
Well, Ole, this is a very complicated issue. And for the members of the audience, the answer to this question is not going to be found in any economics textbook. Rather, the answer is going to be a pragmatic one that stems really from the reading of monetary policy history and central banking history, especially the central banking history in this region. Central banks have always had to consider how to trade off important public policy goals, because central banks are part of the government. Sometimes they're treated as completely independent, but really they're part of the government apparatus. And they have a certain comparative advantage given the tools that they've been given by the governments. So these have to be both considered. And now, what we know is that price stability from our history has to be the preeminent mandate for a central bank. I mean, we can't ever move away from that. We've known periods in history where central banks did ignore price stability to their own peril, and that didn't work out well. Because over the decades, the historical record showed both successes for central banks and failures. And we learned from the many, many failures which demonstrate quite clearly that price stability has to remain the single most important objective of central banks. But I don't think it's too controversial to say that sometimes you have to be careful about this. And I think in some countries in the past, the idea of price stability went a little bit too far. Some monetary policy influencers of the past went as far to suggest that inflation stability was the only mandate that central banks should have. Now, most of those folks who were espousing this extreme view were really the high priests of, who live in ivory towers, in the academic community. And they were not really the central bankers. Pragmatic central bankers were rightly suspicious of this extreme view at the time. And I think over time we've realized that the pragmatic central bankers, especially in this region, have done it the right way instead of being so narrowly focused on one mandate. Now, the Asian financial crisis and the global financial crisis also helped to clarify that inflation alone is not sufficient to guarantee overall stability in the economy, where the central bank has some comparative advantage in adding extra levels of assistance. So some of us at the BIS and others have even argued that narrow inflation targeting regimes actually contribute to financial cycles which can be very disruptive. So now there's a growing consensus amongst many that the core elements or core mandates of central banks should be first and foremost price stability. I would call it macroeconomic stability, as we see more central banks in the world adding in a economic activity pillar with inflation, so they trade off the sort of inflation and output stability. So I call that macro stability. The second is financial stability, and we've talked about that a lot in this region. We've talked about it today, using macroprudential tools, but also using monetary policy interest rates to assist in with macroprudential tools. Macroprudential tools are set over the cycle and not really used in a discretionary fashion, but you use the monetary policy instruments to help out with financial stability at certain times in terms of interest rates, and Governor Veerathai talked about that in terms of the Thai example today, when they hit the effective lower bound in terms of the financial cycle going on versus what was going on in the economy. And we have now exchange rate stability, which is primarily geared towards avoiding excessive movements in the exchange rate, arising mainly from non-fundamental flows of capital flows. And that's, in my humble opinion, these are the three core mandates. If you don't have these, you're going to run into problems, especially if you're in an emerging market. How to do monetary policy in this environment with these mandates is really the art of central banking. There is no textbook that's going to tell you how to put certain weights on each one of these mandates. And what you have to do is you have to figure out where your preferences are in terms of how your economies are set up. I prefer lexicographical preferences, which always put a very high weight on inflation. And here I'm not talking about an inflation target, but an inflation range. If ever, when you establish this range, you go outside the range, basically inflation becomes the #1 enemy, and that's what you really focus on. But within a wide range of inflation fluctuations, you can think of using the tools at your disposal to help with financial stability and with exchange rate stability. So that's how I think about weighting those mandates. Now, in the book, there's some other mandates that are mentioned: climate change, digitization, and I believe inequality, but I didn't see it in the chart today. I'm very skeptical that central banks should get involved in these mandates, even if they're subordinated mandates to the core mandates. And that's for three main reasons. One is that these mandates are largely outside the competency of central banks. I mean, you can think of being a helpful set of knowledge in terms of reading technical material and providing assistance to other government agencies. But we really don't have competency in these areas in terms of central banks and doing monetary policy. And there's no real comparative advantage in using the policy tools of the central bank to help in this ways. And third is probably the most important, which is these issues are too politically sensitive. And once you drag the central bank into discussions of these highly controversial issues, then monetary policy focus on exchange rate stability, inflation stability, and financial stability becomes problematic. And the independence of the central bank may be threatened. And it's with the loss of the central bank independence, the risk of that loss, which leads me to believe that central banks in this region as well as globally should try to avoid getting involved in setting up explicit mandates for these alternatives. That's the digitization, inequality, climate change issues. I could be wrong, and maybe some people in the room will disagree with me vehemently, but those are my views. In the book, there's a very nice discussion of these issues, and I recommend it highly.
Great. Thank you, Andy, and thanks to the panel. We have about 10 minutes left for questions. Yeah, if you want to, sorry, hopefully this has been as stimulating as the first panel and has generated a lot of questions. So,
hello,
Reserve Bank of India, and then
thank you for a wonderful insights on the capital flows. We had equally insightful panel discussion in the morning, and this is also equally engaging. There has been a lot of discussion on interest rate differentials and capital flows in this region, basically. I was just wondering that the capital flows in this region, including India, has largely dominated the equity flows, portfolio flows. So in that milieu, how relevant is the interest rate differential? Whether the growth is more relevant? For instance, in last year, 21-22, we had net outflow to the tune of 5.9 billion portfolio flows, largely equity. And this year, 23-24 so far, April to June, though interest rate differential remains, I mean, it has, US has raised by 500 basis points, India has raised by 250 basis points, so interest rate differential has narrowed down. But we have received around $8.2 billion from April to June so far. So given this, whether we should have a different policy response rather than looking at interest rate differential alone. Like Mangal also in the morning, the first presentation on the book, in the augmented Taylor rule, he included the capital flow risk as one of the variable. Whether that will be really effective, given that capital flows are more aligned to the growth rather than interest rate differential. My second question is for Dr. Laura. Thanks for that wonderful study you have undertaken about asset purchase program. And you have done an even study where the yields have fallen by 15 to 20 basis points after APP. But one of the reasons for, like we have seen in India, for yields to fall was also that the credit offtake by the private sector was very low. So by default for the banks, of course, liquidity through APP was through TLTRO, long-term repos, and other operations was one of the reasons. But at the same time, the credit offtake was very low from the private sector, though it has started picking up now. So maybe that was also the reason for fall in yields. If you see that we have increased cumulatively by 250 basis points from May 2022, but 10-year yields and other yields have not really gone up. They have remained range bound despite such a large hike in policy rate. Thank you.
I'm happy to try to address this issue. I will say that different countries instituted their APPs for slightly different reasons. When I said mostly it was about stabilizing the government market, that was pretty much the same objective across all of the 8 countries. And then beyond that, there were some other issues, like Indonesia was specifically mentioned that they wanted to keep borrowing rates low for their government given the amount of public debt that was going to be issued. Regardless of why one would want to implement it, having low interest rates, of course, is supportive of credit. But there are other elements that influence, whether credit is going to be taken up or not. And certainly in the March of 2020, one of the big questions was whether or not there was going to be any business. So many corporations just held off. They weren't sure where their business plans and their businesses were going to go. And that was even more so for SMEs and households. They weren't sure they were going to have an income. They weren't sure they were going to have a business. And so the APP program was really accompanied by a lot of government programs to help grow credit. So you saw, these credit contingent liability. If you loaned money through some of these programs, the government would back up the loan for a certain period of time. You saw that non-performing loan ratios were forgiven for a while. Restructuring occurred. So there was a lot of other directed credit policies done by the government alongside this APP. And so it wasn't surprising to me to see a really slow take-up in credit. And in the paper there is some credit data. It's not formally in the model because there are too many other variables to control for to be able to see whether the APP was effective in supporting credit. One other sort of subtle point is that even though the drop in yields was not that great, even in the advanced economies, we're talking about half a percentage point. one of the ways to read that is at least they didn't go the other direction, right? We had immense sales of government debt. So at least we didn't see yields skyrocket. In other words, at least we saw something that was in the correct direction. It was stabilizing. It might not have been a lot in and of itself, but I wouldn't consider that to be a failure of the program. I would consider that to be a success of the program, actually. So again, one has to be careful when you unwind it that you don't lose that success, and that can be an issue. But I take your point that credit was slow. It's only now just recovering, and I think that's in part mostly economics and having to do with the government credit programs kind of tailing off, and finally we're seeing some actual growth. So not so much related to the APP.
Great. Thank you, Laura. I think Andy has more to add.
Yes, on the first question, on the observation about the capital inflows, I think you should be very worried, and I think everybody in this room should be very worried. I've heard, there was another fact yesterday that got me extremely concerned about the current riskiness of the environment out here, which is that regional bank stocks have now gone up, basically erasing all the losses it made since the Silicon Valley episode. And what that suggests is that financial markets may be getting ahead of themselves yet again, going into a risk-on episode when really they should be thinking more about risk-off behavior. What we've seen is a very rapid increase in interest rates. Now, Governor Veerathai's charts from this morning showed that interest rate spreads don't seem to correlate well with flows, but risk-on and risk-off behavior does. And I think that's what we're seeing right now, is there's a risk-on behavior going on, but the underlying uncertainties in the economy suggest that it should be more of a risk-off period. So that means we could have an extreme flip in terms of what looks pretty good right now is going to turn back. And the reason is that global interest rates have gone up. We went from a period of low for long. We went from a period where central banks said that inflation pressures were nowhere to be seen then or in the future, to an environment now we have high, sticky inflation with a prospect of even higher interest rates going up, certainly in Europe and the United States, but also globally. This means that any financial institution, and especially the banks that made loans with asset liability mismatches, are going to see their bank balance sheets deteriorate potentially very strongly. And we've already seen that with Silicon Valley Bank, and we saw it with Credit Suisse. Those are just examples. But as Warren Buffett said, this famous line, when the tide goes out, you find out who's swimming naked. I think we're going to find out pretty quickly who's been swimming naked, and it's not just going to be an isolated incident in Europe or in the United States. There could be more there, but I think Asia, and especially as you look towards North Asia, there's some prime examples that you want to follow very closely. And so if this starts to unravel, given the analysis, if that analysis is consistent with what your staff is doing, then you want to start asking questions not just about monetary policy and about capital flow management tools and about macroprudential tools. You want to start asking very tough questions about deposit insurance coverage, because if you look in the United States, the thing that stopped a nationwide bank run, which could have precipitated an international bank run, was deposit insurance. The coverage, not only of the depositors, but the institutions, the different types of intermediaries in your country. So that's what I would say. I'm worried by what you've said. I hope I gave you a little answer, which will make you go back and think a little more.
Okay, thank you, Andy. We had a question from Eddie Frau, I believe. The microphone.
Hi. I'm highly intrigued by Andy's lexicographic references to policy mandates of central banks. The thing is now, we are having a situation where everything's happening at once. So there's a problem maybe on the part of both the central bank and the markets themselves in terms of looking at the policy reaction function of the central banks. I know it sounds a little bit schizophrenic coming from a central banker, not knowing my own policy reaction function, But at the same time, we are hamstrung by the kind of public mandates that we have. You know, what you mentioned about it's a very pragmatic approach, that's very true. But from the point of view of the markets, they can only see the mandates and past behaviors. So what's the way forward here? I mean, the last time we had such a big overhaul in terms of policy framework was perhaps the inflation targeting overhaul that we had more than 20 years ago. So maybe the time is right for some movement towards an overhaul or deeper thinking of this. If that's the case, you know, what's the next step, do you think? Thanks.
So the next step is I think Governor Subbarao talked about it, how the new orthodoxy, the IPF of the IMF, I think is very lacking in certain aspects. Governor Subbarao mentioned preemptiveness. I worry about the notion of the IPF as talking more about the policy tools as being substitutes when they're really complements, and they're trying to create some elasticity matrix of how you implement various tools. I think that's a fool's job to try to do that. That's never going to work. When you think about these tools as being complements rather than in the near term substitutes, you're going to make a lot more progress towards getting a monetary policy framework that is consistent and will take on the challenges that you're facing. So I think a lot more effort needs to be spent on our core mandates, how FXI works in the new environment, how financial stability regulations work when we just found out that all the assumptions behind the Basel regulations and the FSB regulations, which were based on sticky deposits, is no longer true. I mean, we should have known that. But you know, you can get on the phone in the morning, you hear something about your bank, you can move everything in one fell swoop. So do we have to move towards narrow banking, and does a central banker have to sort of get that going? So I think our core mandates require a lot more effort than that's being done, because central banks are being pulled away, their best and their brightest, pulled away dealing with some of these other mandates, which are really not the core. If you can solve the core mandates and get those really well done, maybe it's time to give the government some extra resources to think about these issues. I would mention that CBDC is another one of these issues which, because it has central bank in the acronym, it sort of naturally should be in the central bank. And I think that's another big mistake, that central banks are going to find themselves in a situation where they're going to take on some responsibilities which are going to have a big political sort of aspect, which is like, how do you provide phones to the lower income individuals? How do you provide phones to kids so they can get their allowances? And the central bank doesn't want to be in that situation. The central bank wants to run the computer that clears all these payments, but it really should be a government agency that's actually putting together the plans that are politically acceptable to the public. Now, this is maybe very controversial in this audience, but this is where I stand.
Yeah, I think we should probably leave CBDC for next year's panel. Any other questions from the floor? Oh, yeah. Oh, sorry, Governor Subbarao, we have a mic there for you.
Okay. Thank you. Very rich panel discussion. Since I can't ask all of you, I want to focus on one thing, which is Laura's presentation. Very good presentation. I've not read your report, but I believe Ole must be a very good report. I look forward to reading it. I have a comment and a question. The comment is this, that it strikes me that you thought of studying APPs. You know? Because I remember when I was governor and Penanki was the chair, there used to be a lot of questions to the Fed about QE, etc. Used to be irritated, saying that why do you people talk about QE as if it's something special? That central banks have two instruments, an interest rate instrument and a balance sheet instrument. They're just deploying that instrument. So just treating that as a special thing that central banks are doing, you're exaggerating. That's my comment. The question that I want to ask you, which is going a little beyond your presentation, is this, that you said advanced economy central banks are doing APP for stabilizing markets, and emerging markets for stabilizing government borrowing. Right? Now the question is, should central banks be doing it? I recall that in India there was quite a bit of controversy during COVID time when RBI did that. They said the RBI is actually indirectly monetizing the deficit. Should the central bank be doing it? It is not just a moral question or a ethical question. It's about there's a cost to it, right? The cost is being paid by banks. So should you reward the government and force banks to subsidize the government? So I think we should think beyond this as well. Thank you.
Thank you for those comments, because then it gives me an opportunity to let you know sort of my personal views. First of all, I was a Fed watcher back in the 1980s in a private bank. It was called First Chicago. I was the backup Fed watcher. I was still too young to be a real Fed watcher. But the Fed used to do what are called outright money market or outright operations, outright buys and sells. They would, instead of using the repo rate, they would literally buy, it was called a coupon pass, and they would just literally buy treasuries when needed or sell treasuries out of their balance sheet. And your first comment is, you're right, an APP is nothing more than a normal operation that central banks have been doing for decades. And it always surprised me when we called it an asset purchase program. So, that got me thinking about, well, what's so different about just doing a coupon pass and you're going to control a different part of the yield curve by doing that? And the answer that, I sort of came to was that this was a crisis situation, and those interventions were for monetary policy purposes. They were to lower or raise the yield in a different part of the yield curve than in the short end. So, okay, fine. We're using this as for volatility. I didn't mean to imply that using APPs in emerging markets was to stabilize yields versus prices. To me, they're the mirror image of one another. So it just depends on how you measure your volatility. But if you purchase securities and you keep them from moving around a lot because you have some sort of, again, we could talk a little bit about whether volatility is unidirectional or actual standard deviations, but let's just, for the sake of argument, say that you're putting a floor underneath the price by purchasing it, and that also lowers volatility because people know that you will step in. So your second intervention is, should we be doing it? And here I am very ambivalent about whether we should be doing this or not as a central bank. And it's not as much about financing it's a backup for the banking system. It's a backup for anybody holding debt, not only banks if they're holding debt, but it's also for any other investor. You're being a buyer of last resort, and that is altering the market behavior. That's altering the market behavior when you're doing it, and it's going to alter the market behavior in the future because you have now decided this is part of your toolkit, and you are going to potentially use it again and again. And now we've seen it be used again. We used it in advanced economies during the GFC, and now the advanced and emerging markets have joined in using it in COVID, not just for government debt, but Thailand used it for corporate debt, and for Korea used it for CP and corporate debt. Hong Kong used it to buy equities. So we're the central bank is now the buyer of last resort for a number of markets. I think that's a very dangerous environment to be in, frankly. I don't think the central bank really wants to be a market participant in that sense. So I would be in favor of limiting that to extreme situations and also unwinding it and rapidly enough that this notion of monetary financing does not, eke into the persona, into the perception of the marketplace. The longer you hold the stuff that you acquired during that period, now when are you going to get rid of it? if rates rise, the central bank has a loss. Okay, now what do? Okay, well, it really shouldn't matter that the central bank has a loss, but that's not how the finance ministries think about it, because they're often the recipient of your gains, right? So when you have a loss, it doesn't look good. Also, if you're undercapitalized, I think our Thai friend said that, you know, there were 2 years, and explaining that to the public, well, how a central bank can be undercapitalized is really hard. It's really hard. They don't expect their central bank to be undercapitalized. Does it in the long life of things matter? Probably not. But try to explain that to a normal person. You know, on this, even a person in the markets, you know, that's a very difficult thing to explain. So I'm not a big fan of continuing to do this. I worry about this embedding an idea that the central bank will always come to save the day.
Maybe I just want to clarify one thing. I think a lot of the buying of securities from the market were in the secondary market rather than the primary market, which is tantamount to financing, monetary financing. Only Indonesia, to some extent Philippines, and one other country maybe have done it in the primary market. Not Philippines, only Indonesia did it in the primary market, which is equivalent to monetary financing, where most of these cases it was in the secondary market, which is...
Let me just add 2 points to this discussion. Now, first of all, I think, well, 3 points. One is, I think it's really great that some of the central bankers have tested their systems to make sure that you go and do these kind of operations. So I'm all for testing in case there's a really bad situation that arises. You may actually need to do this. It will have to be very extraordinary. Second point is, there may be a tendency to look at the experience of Japan and others and say, well, maybe yield curve control is the way to go. I don't know. I think we had a BIS meeting. You might have been there in Lake Lucerne when Governor Kuroda was talking about the implementation of yield curve control, and Alan Blinder in the audience said that's exactly how monetary policy should be made. It shouldn't be made with short-term interest rates. That nobody, you know, makes decisions on short-term interest rates. It's all about long-term interest rates. That's a different discussion. I wouldn't recommend it because it could be very fraught with trouble. But to get to your direct point, I think what we have to ask ourselves, and I haven't read the paper and haven't looked at the details of what APP is, but to me it sounds a lot like debt management and what debt managers have traditionally done. Debt managers go in, they provide securities, they take securities off, and this sounds like something that that debt managers should be taking care of and not central banks. In the old days, like you go to the Bank of England back in the 60s and 70s, I believe, I think the Reserve Bank of India has continued to do this, to have the debt managers inside the central bank. Most other banks have moved on and separated them out, and you realize that you can do debt management outside the central bank. And again, it creates this wall between the political side of what's going on and the independence of the central bank. And so if you want to preserve central bank independence, if you're asked about APP, do more. You should try to push it off on the debt managers.
Okay, I think these are all topics that will be with us for some time to come. I'm looking forward to our next getting together and talking about this, but I think it's us, we're standing between the participants and lunch, so if I can bring proceedings to a close, let me thank all the panelists, starting with Nagaraj in Singapore. Thank you for joining us today and also earlier in the week on our Developing Financial Markets course. Thank you to James for flying in from Hong Kong. Thank you to Laura and Andy and Mangal. And obviously, let me also repeat our big thanks to the BSP for putting all of this together. It's been an absolutely amazing 2 days. So thank you very much to the BSP, and thank you to the two co-chairs of the SEACEN Expert Group on Capital Flows, Senior Assistant Governor Iluminada Sicat and Assistant Governor Fra. So thank you. And a big thank you to everyone who came and joined us over the past couple of days. It's been great to see you in person rather than on a little screen. So thank you for making the effort and joining us. we can continue the discussions about monetary financing and central bank mandates on the 5th floor, I believe now. So thanks a lot, and see you again next year, whoever is going to host this event next year. And yeah, over to the BSP, I take it.
So this concludes our program for the morning. At this point, may we invite all of you to lunch reception at the Grand Salon located in the 5th floor of this hotel. For the materials used today, SEACEN will be circulating it to the members after the conference. So our liaison officers will guide you towards the elevators and escalators towards our lunch venue. Thank you.